Cheryl, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning, good morning. Let's start with your scores. Equities, futures, just about positive, bouncing back from yesterday's losses, up by 0.2% on the S&P. The Nasdaq up by 0.2. The Russell, the small caps, up by 0.6. Your day ahead. A little bit later this afternoon, some Fed minutes at 10 a.m. Eastern Time. Revisions to payrolls through the month of March in 2024. Look out for those. We're looking for some big revisions at 10 a.m. Eastern Time. And then we're focused on the earnings this morning. We've already heard from Target and Macy's. A little bit later this morning, we'll hear from TJX. And let's talk about two very different stories this morning. Target and Macy's. Macy's is down by more than 9%. Consumers not great. Target's up by more than 12%. Call it 13%. Consumers absolutely fine. Lisa, explain the difference between these two companies this morning.
Well, there's this real issue of execution versus the macro story, and we've been trying to decipher how much, when people talk about a weaker consumer, that's because of execution, it's sort of the new weather, or whether this really is speaking to that. This is what Macy's CEO had to say, that the company saw a more discriminating consumer this quarter, talking about sales that came in below expectations, falling to 3.8% to $4.9 billion versus the expectation for $5.1 billion, also ratcheting back the revenue forecasts for the full year. That said, still delivering an upside beat to earnings because they were able to be more efficient. What's the takeaway here? Hard to get a concrete read on the consumer. Either this is an execution story in a company that's been having some issues, or this speaks of a broader macro trend. Pick your poison. A lot of people going to the idiosyncratic.
Which consumer are you going after, I think, really matters here. When you're sort of being confronted by discounts all over the place, Macy's not in a great place. And when you listen to what they're leaning into, what are they leaning into? Bloomingdale's and Bluemercury. Why? Higher-end consumer. Seen that repeatedly, aren't we?
Well, we've seen that in terms of just they have the disposable income. I mean, even the housing sector, right? That's the area that's been doing better. That said, I keep going back to execution because companies that cater to lower-end consumers, and that's why I think TJ Maxx is going to be interesting, have also shown some strength. The fact that Walmart and Target showing more sales of apparel, this isn't just an issue of lower-income consumers that are having a difficult time. There is a bigger question here, and I think that this is actually fascinating after decades of decrying the fact that low rates were creating such an even playing field, even for the companies that weren't very good. Are we seeing the good weeded out from the bad? Are we seeing some real delta between the performance of those that are strong and the weaker that can't function in a world where rates are at, where money costs something?
You used the word idiosyncratic, and we used that when it came to Lowe's and Home Depot. How much heavy lifting do you think that word idiosyncratic is doing right now in the retail space to explain away contradictory signals from one company to the next?
I don't know is really the answer. When it comes to home building and the home goods stuff, that's a little bit different just because the housing market seems to be ticking to its own kind of clock, although some people say that that's telling. That's a tea leaf. We heard that from Neil Dutta. When you look at Macy's, you could say actually this shows that people have a small pool of cash and companies are getting more aggressive to get that small pool of cash for their own. And so it becomes a more difficult time for those that have any kind of weaker hand to make headway. You could cast the story in many different ways, which is the reason why you've seen narrative shift that has left everybody with a bit of a crooked neck.
The Target definitely doing better, swinging to growth. That stock is higher by 12% in the pre-market. I think we've both got that crooked neck looking at some of these moves this morning. I want to talk about some of the revisions we might get at 10 a.m. Eastern Time as well. We've talked about the range of expectations. JP Morgan expecting a number of something like 300 and something thousand revised lower over the last 12 months. The range coming out from Goldman Sachs, I mentioned this a little bit earlier, Lisa, anywhere from 600K to 1 million. That's a lower revision, anywhere from 50,000 to 85,000 jobs per month.
Which has been one of the key issues with data dependency on data that is going to get revised and potentially significantly so to the downward type of direction. Here's one statistic that I find interesting. A downward revision to employment of more than 501,000, and this is for the year ended in March, would be the largest in 15 years. So when you start talking about these type of numbers, does that reset the color of the discussion around the labor market and just how robust it is heading into the fall?
The Federal Reserve says it's data dependent. How dependable is that data. Equity futures right now on the S&P positive by 0.2%, just a little bit of a lift. This equity market's doing okay. Yields are higher by a single basis point, 381.80. It's a little bit snoozy in foreign exchange. Euro dollar 111.21. We're negative by almost 0.1%. Coming up this hour, we'll catch up with Seema Shah of Principal Asset Management as the rebound rally takes a pause. Libby Cantrell of PIMCO with Harrison Trump on the campaign trail, and Anders Persson of Nuveen as anticipation builds for Jackson Hole. We begin with our top story. The S&P 500 snapping an 8-day winning streak as traders await payrolls revisions and Fed minutes. Seema Shah of Principal Asset Management seeing stocks grinding higher, writing this. This backdrop is still constructive for risk, and a $6 trillion mountain of cash is ready to fuel risk assets. Seema joins us now for more. So Seema, let's go to the punchline. A $6 trillion mountain of cash. What is that mountain of cash, and why do you think it's going to be unlocked anytime soon?
Hey, John. Well, look, I think there's a couple of reasons. We've seen for the last couple of years investors become cautious. We know the reasons why. There's been COVID, there's a regional banking crisis, but also potentially most importantly is that people have been able to actually make some kind of really interest on those savings. We are on the verge of Fed cuts, likely to move at a slightly faster pace certainly than what people were anticipating just a few months ago. So sitting in cash is no longer going to be attractive. And I do think investors, of course, you need to take into account the entire backdrop. What are we expecting for risk assets? But we do still think there's opportunities and there's a lot of reinvestment risk.
Seema, this is the important question. What is the backdrop? Because you can have a situation where people pile into cash even more, even as rates come down, because they're looking to de-risk away from risk assets. What makes you think they're going to go in the other direction as rate cuts start to come in? What is it about the growth backdrop that tells you things are going to remain pretty strong?
Yeah, and I would say that I think in the last couple of weeks, there's been a lot of revisions. And I think, as Fed said, there's increasing uncertainty at the moment. We're still in that soft landing camp. Like everyone else, we spent the last 2 weeks poring over all the data, the macro data, the consumer, the labor, balance sheets, etc. And we're not really seeing any clear signs of weakness. We know that there's an economic slowdown. That should be of no surprise to anyone. It's been underway, I think, since the beginning of Q2 of this year. But a slowdown doesn't necessarily need to transition to recession. We think that the Fed has got a lot of room to cut rates. So actually, for us, the risk of recession is fairly low. And against that backdrop, equities can still perform fairly well. We're not looking at bumper gains like you saw in 2023 or certainly in Q1 of this year, but that's still some positive gains to be made.
Seema, I love that you go here because Tracy McMillian yesterday was saying of Wells Fargo that she sees this $6 trillion in money market assets heading into equities, maybe a bit more than longer term bonds. Bob Michael of JP Morgan Asset Management saying it will flood into all sorts of core bond funds, leading 10-year treasury yields at 3% or potentially lower. Do you agree with that type of assessment?
So I think there's a lot of opportunities across the equity set. You know, you just have to look outside the US as well, and I think there's a lot of opportunities. On the bond side, you know, I don't know if we're going to see 10 years quite that low. I think there's so many other factors at play at the moment, particularly in an election year, that at least for the time being, that downward pressure is probably somewhat limited. But certainly, I do think there's a lot to go into those core bond funds. There are question marks around high yield, around an economic slowdown, which is why there's still so much interest in that investment grade market. So actually, we think there's an opportunity set across not just equities and not just fixed income, but even across real assets. And so that's the reason why, you know, yes, the economic backdrop is a little bit more uncertain than it was 2 or 3 weeks ago, but it's still really important that investors do start to think that, look, when Fed cuts start, cash is no longer attractive, and actually staying in cash is probably going to be your biggest risk.
Going back to where we started, John talking about a good kind of rate cut and a bad kind of rate cut in terms of what the backdrop is in terms of a good economy or a bad economy. Today we do get those payrolls revisions, the initial payrolls revisions in the year ended in March. Expectation is fuzzy, it's all over the place. But if we see a revision of, say, 1 million fewer jobs as reported initially in that period of time, does that change your view?
It doesn't change the view, but of course it's going to add to the impression that the Fed is behind the curve and that the Fed is going to have to accelerate its movement somewhat more. It's really tough though. You know, you were just saying that there's a lot of difficulty, a lot of risk in focusing on just one data point. We know that payrolls are all over the place. Even if you think back just to April of this year, where you had a revision down to, I think it was a 116 mark, and then the next month it was back up to above 200. So it's really important that you look across a broad set of data, across the consumer space, also really focusing on what is the balance sheet strength of households and companies. And I think that's probably going to be very important for building up that overall picture of the underlying strength of the economy. But certainly, I think it will impact Fed pricing.
Seema, let's turn to gold. Some big moves so far this year. Gold up by something like 20%, around about that. The move this morning, we're down about 1/4%, pulling back from all-time highs. UBS came out with a note recently, and they're looking for a move to 2,700 by the middle of 2025, the middle of next year. And they give a long list of reasons for this move. The Fed shift, central bank buying, portfolio hedges. What do you think the strongest tailwinds behind this move actually are?
So, look, I think the gold movement it's probably been one of the more interesting areas we've had. We've actually maintained a long-term exposure to that gold in expectation that, as you said, a number of the factors all at play. You've got the Fed cuts, you've got the central bank buying, you've got a lot of the risky environment at the moment as well playing in. For us at the moment, I think the concerns around the slowdown, they're probably not going to go away. They're not going to be cleared up in the near term. So I think that upward movement for gold is probably here to stay a little bit longer.
What do you think it should substitute in a portfolio at the moment? Are you thinking about that, where it fits in? What are you telling people?
For gold?
Yeah.
Yeah, I mean, I think having that exposure to real assets is really important. Something around the inflation mitigation, to me, that is where gold also fits in. So I think it ticks a lot of different boxes. Somewhere along, having some kind of downward protection, but also focusing on what happens if inflation does turn out to be sticky. I know we talk a lot about recession risk, but to us, one of the key concerns that we're thinking about over the next 2 years or so is what if actually inflation does start to take off again once you've got a number of Fed cuts, and then that becomes more of a worry. So I think having that real asset exposure, commodities, anything which is a bit of inflation mitigation still deserves to be a core part of any portfolio.
Just to put a line under that, Seema, are you saying on the margins, real assets should replace long duration bonds?
I don't think that they should replace. I think that there is an area which they are taking a box for. Long duration bonds are important if you want to have that downward, or I should say that protection against downward economic risk. Gold is a slightly different element, but I do think that across equities, across the fixed income, and the alternative space, there does need to be exposure across all three because you are ticking all your boxes in terms of the risk environment in front of us.
Interesting. Seema Shah, Principal Asset Management. Seema, thank you. The range of outcomes is that wide that you need an allocation to all three?
Because otherwise, you're not going to be hedged. This is really the issue, is that you have a bifurcated risk profile. You have on one hand the potential of a real negative economic backdrop that leads to inflation coming way down and rates coming way down, positive maybe for long duration bonds. And on the other side, you have inflation rearing its head, causing some sort of downturn, et cetera, which would be very bad for bonds. Either way, she's saying gold, might as well just throw a chip that way.
It's a very dramatic conversation. There's no drama in this market this morning.
Zero.
Yields are up by about a basis point. 10-year equity futures are positive by 0.2%. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Target surging in the pre-market after ending a string of sales declines in the second quarter, citing improved discretionary spending up 13.8%. The retailer said comparable sales rose 2% in the quarter, higher than the average analyst estimate, while breaking 4 straight quarters of contraction. For Macy's, as you can see there, not such great news, down nearly 9%. It cut its outlook for sales for the rest of the year. Revenue in the last quarter fell just shy of estimates. The company said a, quote, challenging consumer environment contributed to the weakness. The U.S. Federal Trade Commission's ban on non-compete agreements has been blocked by a federal judge. It was set to go into effect next month. In a ruling yesterday, a U.S. district judge in Dallas sided with the U.S. Chamber of Commerce and a Texas-based tax firm that sued to block the measure. She said the FTC lacked the authority to enact the ban, calling it unreasonably overbroad. This case is one of 3 lawsuits challenging that rule, with the others pending in Florida and Pennsylvania. Uber has hired a former Tesla executive to oversee the company's transition to EVs. Rebecca Tanucci will start next month as the global head of sustainability, as Uber aims to use zero-emission vehicles for all of its rides and deliveries by 2040. At Tesla, Tanucci helped open the car maker's charging networks to other car brands. And that is your Bloomberg Brief. John.
Danny, thank you. Appreciate the update. Just a quick update again on shares of Target, up in a pre-market by more than 13%. Macy's suffering a little bit. We'll get numbers from TJ Maxx later on this morning. Plenty of reaction to those numbers. Up next on the program, we'll head to the DNC in Chicago and catch up with Anne-Marie. And around this table, we'll speak to Libby Cantrell of PIMCO from New York. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Retail earnings a big focus for us this morning. Numbers from Target, numbers from Macy's. Later on today, we'll get numbers from TJ Maxx. The fate of two very different stories today for these two stocks. Take a look at Macy's and Target this morning. Macy's down by 8%. At least a Target up by 13.
Both of them cutting prices, which I think is interesting. If you want to take a look at some themes, it's just that Target was able to execute more and broaden out the range of sales. Macy's coming in short for the revenue as well as sales forecast for the full year. We're going to have this conversation ongoing. I'm not going to use the I word again. I've already gotten pilloried for it.
Idiosyncratic.
How much, whatever. How much is Macy's a story of execution, and how much is it a matter of who they're targeting in terms of a consumer base? They talk about uncertainty in the consumer. Target had anything but. It talked about resilient of the consumer at a time where it really is breaking out of a funk.
If TK was with us this morning, you know what he'd say? He'd be brutal about this. When was the last time you went to a Macy's? Who wants to go to a Macy's? That's what he'd ask.
You know, and he's not wrong, and that's the reason why they're leaning into some of their more loved brands, like Bloomingdale's, like Bluemercury, that cater to a higher-end consumer, but also haven't been through so many cycles. I mean, the Macy's in Herald Square has gone through a number of cycles.
It's a little bit dated, isn't it?
With questions around certain things.
I'm not sure I want to go to Herald Square either.
Vintage.
Yeah.
I like the vintage.
You want to call that vintage?
The vintage. the vintage escalators. Can I just say, I used to take my kids there when they were really little, just to look at the escalators and show them what they used to look like. We didn't actually buy anything. Let's move on.
Oh, trips with Bramo when you're a kid. Good stuff. Macy's down by 8%. Under surveillance this morning, a stark contrast on Law and Order.
Kamala Harris will deliver crime, chaos, destruction, and death. If she's allowed to be the president of the United States, you'll see levels of crime that you've never seen before. I will deliver law, order, safety, and peace.
I do believe, bad behavior should result in a consequence.
Well, we will make sure he does face a consequence, and that'll be at the ballot box in November.
The campaigning continues throughout today. Anne-Marie joined us from the DNC in Chicago. AMH, what's coming up?
Well, Jonathan, you really have both of these camps leaning into different messages. Trump will be in North Carolina with J.D. Vance today talking about national security, and then tomorrow at the border. So really this idea, are you safer abroad and at home with Biden-Harris? And then Kamala Harris and the DNC is picking up on a theme of freedom tonight. We're going to be hearing from Governor Tim Walz, who she selected as her VP, an individual that really wasn't well known to the American public. He had a very moderate voting record, Jonathan, when he was a member of Congress, but then moved starkly to the left as governor. He's come under a lot of attacks about his military record and also most recently about the fertility journey of his family. He'll potentially lean in and talk about these issues, maybe clear some of that up this evening. And then who I'm really interested in hearing from is Speaker Nancy Pelosi. Yesterday at the end of the roll call, when Governor Newsom introduced California with Tupac and Dr. Dre singing in the background, he said, "I come from the great state of Nancy Pelosi." In many ways, this is her convention. We are a month out when Kamala Harris would have been speaking tonight as the VP candidate, Jonathan, on this ticket.
What a big change in a very, very small amount of time. Anne-Marie from the DNC in Chicago, thank you. Libby Cantrell of PIMCO is with us around the table. The last time Lizzie was with us, she told us to go to the beach, get a cocktail, and ignore the politics. Libby, can they stay there at the beach?
Just stay at the beach.
Can they stay there?
You have 2 more weeks. Just enjoy, every ounce of sunshine and what have you. Yeah, I mean, we are telling our clients that this is still, first of all, it looks like it's a dead heat as of now. I mean, the interesting thing is despite all of the drama that we have seen over the last 6 weeks or so, and it has been dizzying, the race is effectively where it was in the spring when Biden was still at the top of the ticket. It is effectively, again, a dead heat, kind of a jump ball. The down ballot races, we've talked about the composition of Congress, very important to the markets in terms of fiscal policy. Right now, the House looks like it's also a jump ball. So these things have, in some ways, they've taken a round trip, if you will, over the last few months, despite sort of the dizzying nature of the events.
Do we have better clarity on policy, though, over the last few months? Have we got anything on that front?
Do we have? So there's another thing we're guiding our clients, about is that if this is an election about personality, about vibes, Kamala Harris could do very well. If this is an election, on the other hand, about policy, then she's quite vulnerable, and you could see Trump winning. And I don't think you've necessarily seen her define her policy platform with the specificity that the policy nerds would like around the table. At the same time, I don't think you've seen former President Trump really litigate some of those policy issues. We've learned a little bit more about her tax platform. If you remember when she ran for the Democratic nomination, she had a very progressive tax platform. She certainly moderated that. But also some of the things that she's advocating still out of step with the market. The corporate tax rate increased from 21% to 28%. Potentially the taxation of unrealized capital gains for those making more than $100 million. These things are not likely to actually get passed, just given what looks like the composition of Congress, but also not necessarily in line with those swing voters. And those are the people that we need to get. This DNC is all about rallying the base. That's great for her, but she also needs to get those swing voters in the crucial states like Pennsylvania and Wisconsin and Michigan.
So taxes is really where she's most vulnerable. If people were actually looking at policy, is that what you're saying?
I think taxation, she's vulnerable. I think trying to separate again from that policy platform that she ran on in 2020. Immigration, though, she's incredibly vulnerable, and I think they're trying to get in front of that in terms of the law and order, but just generally the vibes on the economy, right? I memean, she's trying to distance herself in some ways from the Biden presidency, but she's still the sitting vice president. So how effectively can she do that? The big vulnerability for Biden when he was on the top of the ticket, economy, inflation, immigration, I think those still will plague her. But again, if this is about personality and vibes, then maybe she can overcome some of those obstacles.
It feels like this entire election season has been solely about vibes, and everyone has been waiting for it to change, and it never has, even with the change at the top of the ticket. The vibe was that Trump was in a better seat because he wasn't Biden and he could form a sentence better than Biden. Now there's Kamala Harris, who's in a better seat because she's a newer face than Donald Trump, and there's a lot of animosity toward him. How long can that maintain some kind of the momentum? I mean, in other words, can this just simply be the anti-Trump platform?
I mean, it could be, and I think this is the thing that's the big open question: is that can Trump litigate against Kamala Harris on policies where she's vulnerable, or or not? And I think that remains an open question. I mean, the last few weeks, he clearly, by I think the campaign's own admission, they've had a difficult time sort of stabilizing that campaign, reorienting toward a Kamala Harris as an opponent. So it's certainly possible. But this is where it becomes very difficult in terms of handicapping this election. I think we will get more clarity in September and October, but we're not only are we 2 months, a little bit more than 2 months out of the election. Just remember that Pennsylvania, the most crucial swing state in my view, goes to the polls in terms of early voting September 16th. So this could simply be a vibes election, and Harris would benefit from that, obviously. The most compressed general election cycle in many ways.
That is not what Ramo wants to hear at all. You don't want us to be a vibes election at all.
The policy nerd on the table does not either. I mean, this is, yes, we want this to be about policy.
It's amazing that this race is as tight as it is, given that the two biggest issues are two issues that the Democrats poll really poorly on, which is the economy and immigration. This comes back to the prosecuting the case issue for the Republicans.
That's exactly what I was going to say. The whole idea of can Trump litigate this? And when people say, come on, you need to go to the policy, it hasn't panned out in the way that they've wanted so far. That's the reason why September 10th is going to be so important.
Oh, big time. Debate date. Circle that on the calendar. Libby says you can stay at the beach for another 2 weeks. Libby Cantrell at PIMCO.
Thank you.
Have fun. Coming up on this program, two very different stories in retail. Target and Macy's. Up next from New York. This is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Yesterday, snapping an 8-day winning streak on the S&P 500, incidentally the longest winning streak of the year so far. We came this close to the longest daily winning streak going back 20 years to 2004, falling just short of making it day 9. This morning, positive by 0.2% on the S&P, on the Nasdaq up by 0.2%. Also, lots to talk about in the bond market, so let's talk about it. The 10-year yields right now higher by a single basis point, 381.99. JP Morgan Asset Management's Bob Michael joining the program yesterday. Lisa leading the Bloomberg Surveillance newsletter with this. 3% yields or lower at the long end of the curve at some point going into next year.
And he's saying it's not really a bet on duration per se. It's just that there is that $6.2 trillion in money markets and that it's going to flood into general aggregate bond funds. And guess what? A lot of that's going to go into the 10-year. Already the 10-year around the lowest levels going back to early this year.
We'll get you some numbers from TJX in just a moment. I just want to turn to foreign exchange just briefly and look at dollar yen. Dollar yen at the moment no longer at that 160 that we were talking about over the last couple of months. We're now down to about 146.17. I just want to mention this as an excuse to tell you this. Japan hosted 3.29 million foreign visitors in the month of July, a monthly record, a 10% increase compared to July 2019, pre-pandemic.
One figure really stands out, and that is the peak weakness that we saw in the Japanese yen that some people might have nailed with their children's trips over to Japan. Here's the thing. At a certain point, you hear about tourism coming from China going to Japan in order to capture the weaker currency. You talk about the U.S. Everyone was going to Japan. Question is how much that's a boon for the economy that's going to allow the Bank of Japan to continue hiking rates at a time when they've been looking to normalize.
That's the latest on Japan. Let's get the latest on TJX. TJX, Lisa, with a better outlook looking at these numbers this morning.
Macy's is looking more and more like an outlier. They're basically raising their full-year guidance for both pre-tax profit margin as well as earnings per share, seeing full-year comp sales, comparative sales, up 3%, previously seeing 2 to 3% versus the estimate of about 2.75%. This, to me, highlights just how much you see some of the deals being rewarded and those that are lagging behind falling further behind. Earnings per share in the second quarter of 96 cents versus the expected 85 cents year over year. You could go through all of the metrics. Bottom line is this. There is a story that is consistent with TJX. There is a story that's consistent with Target. Macy's is the outlier. Pick your poison in terms of the narrative that you want to place around that.
You can see that based on the price action as well today. TJX up at a pre-market by more than 4%. If you look at Target, that stock is absolutely flying. Macy's is moving in the other direction. Lisa, to put it simply, what we're seeing is a better outlook for sales, better margins as well. Profits win.
We saw that with respect to Target as well, and this goes to something that people are talking about because they're cutting prices and yet they're increasing margins. This isn't an issue. A lot of people, including the companies, will say it's not an issue of price gouging. It's quite the opposite. They're dropping prices, and yet efficiencies have enabled them to eke out a greater profit. Question here is, how much is this artificial intelligence? How much is this, some kind of changes in different technologies that they use versus just who they're hiring? Some real questions here about why you're essentially seeing productivity increasing as they increase profit margins without necessarily increasing prices as well.
As we speak, Jennifer Bartashes of Bloomberg Intelligence is pouring through these numbers. We'll catch up with Jen in about 2 minutes' time. I just want to go through some other top stories for you. Under surveillance this morning, an Associated Press and NORC poll finding that Tim Walz is better liked than J.D. Vance. 36% of U.S. adults have a positive opinion of Walz, with 27% holding that same view of Vance, and he wins with independents as well, which, as we know, is going to be pretty crucial going into November.
That said, when you dig into the numbers, a lot of people had no view because they didn't know either of these people, right? So you take a look at the actual underpinnings. It's hard to get a sense. There also was a significant cohort of people who did not have a favorable view of Governor Walz. I believe about some 44% versus 42% for J.D. Vance. These are numbers that really highlight the lack of knowledge around two potential running mates that really is a completely different race. And I think that's the reason why is it October 1st that you have the vice presidential debate after Pennsylvania already goes to the ballot with early voting. There's a huge discovery process here in this Vibes election of 2024.
Even the former president, Donald Trump, has basically played down the importance of a VP pick, hasn't he, over the last few weeks?
Well, there's a reason for that. A lot of people say that it was a mistake. Look, he was trying to double down on his base with J.D. Vance. J.D. Vance is a polarizing figure, and that's been bearing out in the polls. Really, key question is, does Tim Walz play a bigger part in the Kamala Harris campaign, or is this basically less important at a time where people are just sort of feeling out what the right vibes are?
Bit of trivia for you. I ask this question sometimes, and I'm surprised by how few people actually remember. Running mate, Hillary Clinton, 2016. Do you remember?
Was it Lieberman?
Tim Kaine.
Oh, yeah.
Yeah, you see? Everyone's forgotten.
Well, I mean,
everyone's forgotten.
Okay, but I have a bad memory. Do you remember that?
I asked that question. I've asked so many people that question, and they've forgotten who a running mate was.
Do you think that it was fair that he was brought down by the roar? Do you remember the roar?
I don't even remember the roar.
He went, and then he had to step down.
On race. Do you remember Jeb Bush, please clap?
Oh, yeah.
Do you remember that?
Yes, I do.
It's a weird couple of years.
Good times.
Yeah, okay. I think we've forgotten a lot, maybe for good reason. Let's turn to Walmart, raising about $3.6 billion by selling its stake in Chinese e-commerce firm JD.com, winding down an 8-year partnership. Bloomberg learning Walmart is focusing on expanding its own e-commerce and delivery system in China. JD getting whacked. In the pre-market, we're down by 7.6%. Lisa, I just think we've seen a series of companies making some interesting moves around the story in China. And I just wonder how connected even Apple producing their iPhone, a certain iPhone in India, is connected to all of this sort of de-risking and pulling back around the story in China.
I love that you and I basically read the news the same way. We come in the morning and we're saying, wait, is this connected with Apple basically increasing production, albeit marginally in India? You see what's going on with getting out of some of their stake, Walmart, of JD.com in China. And then, of course, LVMH coming out and saying they were cutting staff at Sephora in China. Two issues here. Is this a weaker consumer in China? Or is this that U.S. companies are losing less of a competitive edge in China as some of the tensions do continue to percolate between the U.S. and the world's second biggest economy? This really is what we're watching. Question that I have also is how much are we seeing and how much are we not seeing? Because it is political malpractice or business malpractice to really say this out loud before you've moved considerable operations out of China, considering the potential retaliation from government officials.
Everyone's a diplomat when it comes to that story in corporate America, it seems. Let's turn to the retailers. Lisa going through the numbers for us this morning. TJX out just moments ago. Target surging in the pre-market. Earnings beating expectations with a boosted outlook. Macy's trading lower after cutting its forecast, citing a challenging consumer environment. I mentioned that the team at Bloomberg Intelligence were pouring through the numbers. We can catch up with them now. Jennifer Partashis joins us now for more. Jen, let's go through this. What explains the difference between what you see in a Macy's and what you see in, say, Target and elsewhere?
Well, I think what's really interesting is that, Target historically has really kept the consumer at the center of everything they do. And Macy's has been trying to execute against its strategy. But if you take just one area as an example of maybe private label, Target does a really good job of turning that over, keeping it fresh, and putting it in front of consumers. And Macy's is still in the earlier stages of really executing on private label. So when it comes to which audience they're targeting, how well they're executing, I think that's what you're seeing playing out in today's results.
Well, let's sit on the execution over at Target. Target has had some difficulties for sure over the last few years. What have they changed, and what tells you that a swing to growth can continue for this company?
Well, they had actually been on quite a tear and then had some missteps last year. Since then, what we've really seen is kind of a refocusing of their efforts. And that's a combination of making sure that they've got the right assortment. It's about lowering prices on essentials, reinforcing that value message with consumers, which is the message that we've been hearing from Walmart, what we're seeing in the results from TJX this morning. Value is king. And so the price investments Target's making, the emphasis on lower price points in discretionary categories, those are the things that are really igniting sales and bringing people back into the stores and shopping online with them.
Jennifer, how do you understand expanding profit margins at a time of lower prices and value?
Well, I think this was touched on just before this segment where you were talking about just increases in productivity. But one of the things to remember is that during the pandemic, almost all retailers introduced a lot of extra cost into their supply chains because they were desperate to make sure that they had items in stock. We're at the process still of where we're unwinding a lot of the redundancies that were introduced and a lot of that extra cost. So this year is especially in particular, a bonus year where they can take extra cost out of the supply chain. It's enhanced by lower transportation costs. That is not likely to continue into 2025 because they're sort of reaping the benefits of that low-hanging fruit. But that, along with other productivity initiatives like AI, are all starting to make a difference.
There's this issue of how much some of these results have to do with execution and how much have to do with a resilient consumer. We did hear from Target's CEO that the consumer continues to be resilient, albeit sensitive to value and albeit sensitive to bringing inflation down and keeping the price point affordable. Macy's talked about more macroeconomic pressures. Which is it? Are these specific execution stories, or is there real pressure that's limiting the overall pool of cash that consumers have to spend?
Well, I do think that there is real pressure that limits the overall pool of spending. People are still a little bit conservative. Wage growth isn't as strong as it had been in the last few years. The savings rate for people is slowing. They've burned through some of their savings. So people are spending, but they're being thoughtful in how they're spending. And so when they can achieve something with value, they feel good about their purchase and they feel more inclined to make it. So execution around that idea of how you get people to appreciate your value. And value is not just price. It could also be about quality. It could be about convenience. It could be about lots of different factors. But getting people to appreciate the value of what you offer is really what's helping drive some of these results.
Jen, just to put a bow on it, you don't offer buy, hold, sell ratings, so I won't put you on the spot to ask for that kind of thing. But are there parts of retail that you're more constructive on going forward from here than, say, other parts?
Well, I would say that the players who are in the middle and are able to service lower to middle income households, as well as drawing in more higher income households with that message of value and with strong execution, are the companies that I would be watching.
Got it. Jen, thank you. Jennifer Bartashis there of Bloomberg Intelligence. On the latest, we've heard from Macy's, we've heard from TJX, we've heard from the likes of Target, and as you said, Macy's seems to be the outlier so far this morning.
Which then goes to this point of, will some of the weaker hands end up getting weeded out in this time where money is no longer free? I do need to make a correction.
What's that?
And several people have written in to correct me on this, so I want to say thank you. I was talking about Tim Kaine going, "Rawr," but it was actually Howard Dean back in 2008. And what this highlights to me, I can actually draw the parallel to the whole vibe idea of a presidency. Well, isn't it the same thing if that could torpedo a candidacy was just simply roaring in a way that lodged itself in our memories? And I think that Howard Dean does look a little bit like Tim Kaine anyway.
Well, I mentioned Jeb Bush and please clap, and that's not what basically derailed him. He was already losing, which is why it becomes so desperate.
Right.
Please clap.
It's just sort of...
Not to go after Jeb Bush. Jeb Bush this morning. But yeah, a lot of these things, we think they matter at the time, but ultimately it all gets forgotten years later, doesn't it?
Except that, you know, I made a mistake, and a lot of people still did remember the Howard Dean mistake, the Howard Dean scream. Please, keep them coming. I love the feedback, and it's helpful to remember that. I actually enjoyed it. It's sort of encouraging and motivational.
I'm going to find the video in a moment. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John, just to recap some of those retailers, Target is surging in the pre-market, up 12.6%. It ended a string of sales declines in the second quarter, citing improved discretionary spending. TJ Maxx also up more than 5% pre-market. It reported second quarter net sales that beat estimates, saying the growth was driven entirely by customer transactions. And as you can see there, not great news for Macy's, down 8 1/3% in the pre-market. It cut its outlook for sales for the rest of the year. Revenue in the last quarter fell just shy of estimates. The company is saying a, quote, challenging consumer environment contributed to the weakness. Now, mortgage applications for home purchases slid last week to the lowest level since February, as tracked by the Mortgage Bankers Association. Applications to buy a home fell 5.2%. Refinancing applications also tumbled after surging to a 2-year high in the week prior. Now, all of that is despite an easing of mortgage rates, which at 6.5% for a 30-year fixed contract is the lowest since May. But housing affordability is still its worst in decades, preventing an upswing in demand. Now, on the luxury side of things, Toll Brothers is seeing a spike in demand for luxury homes as those mortgage rates fall. The home builder saw purchase contracts rise 11% year over year. While that number missed estimates, Toll said it is still seeing solid traffic and expects momentum will continue. Toll's customer base tends to be wealthier with more cash on hand compared to the average home buyer. That's keeping demand steady as competitors see sales lag. And that is your brief, John.
Danny, thank you. More on the home builders in about 30 minutes. We'll get the views of UBS. That's just around the corner. Up next on the program, a soft landing in sight.
I think they should just do nothing. All the data has come their way. They've guided us to a feathery soft landing. Just don't mess it up. Start cutting rates in September, and let's get on with it.
Then everybody's going to buy bonds. That's this beautiful bedtime story for bond investors that Bob Michael at JP Morgan is telling people. And then yields are going to 3% and maybe even lower. We'll talk about that next. From New York, this is Bloomberg.
The top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Stocks right now in the S&P 500 shaping up as follows. Going into the opening bell a few hours away. Equity futures up by 0.1%. Bond yields going nowhere right now, 381.23. We'll get into a big call from Bob Michael at JP Morgan in just a moment. He's looking for 3% and maybe even lower on a 10-year over the next 12 to 18 months. Under surveillance this morning, a soft landing in sight.
If you leave restrictive rates at the level they're at currently, then that worsens the labor market, and then you've got not a problem with inflation, but the pace of disinflation. I think they should just do nothing. All the data has come their way. They've guided us to a feathery soft landing. Just don't mess it up. Start cutting rates in September, and let's get on with it.
And the message after that was to keep cutting interest rates and keep cutting interest rates. And then it introduces this conversation, Lisa, about a 10-year drop into 3% and maybe going even lower.
Because it goes to that wonderful pool of $6.2 trillion in money markets that will be unleashed into income, which means further out the curve, which means it'll eventually find itself to that 10-year yield. And then you'll see that wonderful combination of both lower yields and an economy that is not falling off a cliff. I love that he says, do nothing. But if he were Jay Powell, he'd get up and he'd say, I'm ready to slash interest rates. And let me tell you, this is the last time you're ever going to be able to get this kind of yield in money markets.
Yeah, Bob had a long list of things that he would like Chairman Powell to say on Friday, and then a long list of things he does not expect Chairman Powell to say on Friday. Here's the view from Anders Persson over at Nuveen. He writes the following: we expect the Fed to cut by 25 basis points at each meeting through mid-25. Larger cuts, including a 50 basis point move in September, are possible if incoming labor market data continues to deteriorate at the same pace as the July jobs report. Anders joins us now for more. Anders, good morning to you.
Good morning.
We talked a lot about the jobs revisions we get a little bit later this morning. Torsten Slot came on the program from Apollo and basically caused poured threes in cold water all over the conversation Lisa and I've been having all morning, has said it won't matter to markets. Do you think this is going to matter to markets at 10 a.m.?
I'm actually more in Torsten's camp that I don't think it's going to matter a whole lot.
Why is that?
I think it's a backward-looking number, of course. It's year-to-date through March, so it's slightly outdated at this point. I think it's a number economists will definitely digest and kind of take a harder look at. But from a market perspective, I think we're really more focused on what's happening here going forward. And obviously, the most recent data was more interesting, and we're more focused on what's coming here going forward. So I would say, historically, this has not been a number that's been all that market-driven. I don't anticipate it to be today either.
Don't you think where we've been informs where we're going? And the reason I asked that question, if Goldman's right and we get a revision low of anywhere between 50 to 85,000 jobs per month, wouldn't we have traded on that data a little bit differently over the last 12 months?
Yeah, I mean, I think today, this year, given the job markets, is very much front and center in terms of focus. And I think the market has shifted from an inflation focus to more of a job markets focus right now. So I do think this year, this time around, it's more of a more interesting data point. But at the same time, I think the numbers, if you look from like 300,000 to 1 million, the estimates are very, very wide. So economists can't even kind of agree on what the numbers should be here. So yeah, it's a data point. I think we have to digest it. But, quite frankly, I think the market's going to be looking more forward and to certainly the NFP number coming in September.
Part of the problem is that we've talked about the importance of data dependency, and then person after person comes on and says, but does the data actually matter? And we're left scratching our heads with our whipsawed necks and looking at all the data between Macy's and TJ Maxx and wondering what matters to anyone. You're talking about the idea of 10-year yields being in fair value around 4%. Bob Michael is talking about 3%, and you both don't see the economy falling off a cliff. So why are you not in the 3% camp?
Right. Well, I think Bob is referring to 3% some time out, right? Like I think you mentioned 12 to 18 months out. I think that's much more realistic. Right now, we're talking fair value around 4% as we're sitting here today. From our perspective, we think the 10 years is run a little bit too quickly here. It is sort of a slower kind of type month. I think there's some investors out there probably using that as a cheap option versus equity, so to say. So if we have a harder landing, they can use that part of the market to kind of hedge that bet a bit. So we are expecting the 10-year to start moving lower in 2025. We're not expecting as low as that, but 3.25 is possible by year-end 2025. But that's a long time out, and the volatility has been quite severe, so to say. So today, as we're sitting here, it feels like we've gone a little bit too far, too quickly. So that's that 4% that we think is a little bit more closer to fair value.
That said, if you truly believe that the Fed was entering into a rate-cutting cycle, and if you truly believe that the neutral rate wasn't that different than it has been historically, that really we just saw distortions from the pandemic, why wouldn't you hoover up as much for 10-year bonds as you possibly could right now ahead of 2025? Why wait? Why be cute about it?
Well, I mean, I think the trend is lower for sure. So that is, the backdrop that we've been saying for some time. The rates should start moving lower. I think the 2-year is going to be a lot more quicker to move, and we're expecting the 2-year to start moving lower, and we're expecting a flat yield curve by year end. We're actually seeing also an upward sloping yield curve going into next year. So, probably more comfort around the 2-year moving lower, and that's going to be more correlated to Fed cuts as we move into next year. The 10-year, again, yeah, I think the backdrop will be lower for next year, but there are a lot of moving pieces here. We've seen a lot of volatility. We have actually found more opportunity in the spread markets in general, and I felt more comfortable putting bets on that side, less so on the treasury market at this point.
Where are you on credit spreads right now? Because they've certainly tightened and come in over the last week. What are you waiting for?
Yeah, credit spreads we think are, probably fair value to a bit rich now. We have been waiting for spreads to start widening out as the economy starts slowing. It had a very quick move, 2 weeks ago or so.
100 basis points.
Exactly. So very quick move, and it came back very quickly. At this point, we're expecting that to start widening out a little bit. So high yield around 320, we could see that going out to maybe 350 again. as economies start slowing down, and we're more focused on that. So,
can you walk us through your process just a little bit? Because I hear this a lot in stocks. We both hear this when it comes to stock markets. People come on the program and say they want to buy the dip. Then the dip happens, and they keep running away because things get scary. You start to wonder where the next 5% is coming from, and you start to worry that it's lower. Yeah. Same thing happens with credit spreads. You get 100 basis points of widening, people start to freak out. There's another 100 basis point around the corner. How do you know when to buy? What's the process for you and the team?
Yeah. No, I mean, we debate that all the time, and I will say the credit widening we saw a couple of weeks ago was really quite tricky, given that you had the jobs data on Friday, you had the carry trade unwind, and some of the geopolitical uncertainties going on all at the same time. So dissecting exactly what was driving what and how much was technical versus fundamental was quite tricky from that perspective. I think if it was jobs data driven only, we would have had more comfort stepping in and saying, listen, this looks cheap and this is an interesting opportunity. We did step in for basically buying credit and bonds that we particularly like, take advantage of that way. But generally, I think it's an assessment that gets quite convoluted, and you have to basically take it in totality. So from that perspective, a lot of times we've seen in the past, if you have a big move like we did 2 weeks ago, it can be more coming behind it. And that is the tricky part at this point. So we're trying to be dollar cost average, so to say, a bit here, with the assumption that we're going to see spreads moving a bit higher in the rest of the year.
Just real quick, the $6.2 trillion in money markets, which asset do you think will benefit the most if people start to move it out?
Clearly, I'm a bit biased here, but I do think fixed income is going to be the natural next step here. Taxable fixed income and munis overall. I do think it's a pretty big step for somebody who is concerned about what their views are on economy and the markets to jump all the way into equities or all the way into real estate or even private credit. So it does feel like the natural next step would be munis and fixed income, and we're starting to see and hear that more and more. And quite frankly, I think a Fed cut would probably be a nice psychological kind of step towards that, where it's reinforcing to investors that it's time to make a shift here, and that's what we're anticipating.
At least you're honest about where the bias comes from. Anders, thank you, sir. It's good to see you. Anders Persson there of Nuveen. Your lineup for the third hour of Bloomberg Surveillance looks a little something like this. We'll catch up with Sarah Hun of Empire Saxon Woods, John Lovallo of UBS, Veronica Clark of Citi, and Krishna Mamani of Lafayette College. Looking forward to a conversation, Lisa, I have to say, on the home builders. Mortgage applications terrible this morning.
This question around, is this just an idiosyncratic sector, or is this emblematic of weakness stemming from the high rates that we've seen from the Fed?
Equity futures on the S&P doing a little bit better. We are firmer by almost 0.2%. That conversation and a whole lot more just around the corner. The third hour of Bloomberg Surveillance up next.
Institutions you've been very philanthropic with is your alma mater, Harvard. But recently, you've been very public about your criticism of the way Harvard handled the events of October 7th and their aftermath. Could you talk about that now?
The first reaction of a group of 34 Harvard student clubs on the morning after October 7th was to put out a statement saying that Israel was 100% responsible for the acts of Hamas. And my view on that was, that's ridiculous. You can come out and say, look, I'm very unhappy about Israel's treatment of Palestinians in the West Bank, or you can say, we can talk about Gaza Strip, but you can't support terrorists, and particularly terrorists that rape and pillage and murder and burn and take hostages. Well, I got actually a text from a CEO in my industry. He's like, Bill, you know the people at Harvard. I'd like to know who the students are behind these clubs, so I make sure I don't inadvertently hire them. And so I tweeted out that sort of made that point, and caused a bit of a firestorm. And I got a lot of pushback. Why are you picking on students? And I said, look, you can't hide behind a corporate entity if you're going to support terrorism.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, we can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage, and what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
There's been a step up in concern about the consumer.
There's probably a little bit more downside risk in the economy than the markets may appreciate.
Good situation here. Things are indeed getting better.
There's enough good going on to offset whatever the weakness is.
Overall, the consumer is hanging in there. That's why the economy is going to continue to expand.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, 90 minutes out from the opening bell. Let's start with the scores. Then we'll turn to the day ahead, and we'll get to some top stories of retail for you as well. The scores look like this. Equity futures positive by 0.1% on the S&P 500, snapping the longest daily winning streak of the year so far in yesterday's session. 8 days of gains gone, with a very small mild move lower in yesterday's session. That's the score this morning going into the opening bell. Here's your day ahead. Had a ton of earnings already this morning from the likes of TJX, the likes of Macy's and Target. Still to come, 10 a.m. Eastern time, we get the revisions to payrolls and then Fed minutes at 2 p.m. Eastern this afternoon. I want to talk about those retailers, though, that have already reported. Let's go through some of these names. 3 very different stories, or I should say 2 very different stories for 3 different names. Macy's is one story. That stock is down by 6%. Everything else is kind of okay, and things are better than okay for the likes of Target. Lisa, Target up by 13% in early trading.
Increasing their expectations for revenue, for comp sales, looking at earnings that actually came in stronger than expected, margin expansion, even as they cut prices across the board. A real question here about how much this is a consumer that's looking for value versus searching outside of just simply consumer staples. And this is what I thought was interesting. It was also the apparel areas, the non-sort of basic staples that people were going into for Target. Yes, this is an easy comp type of story also, based on some of the controversy a year ago. Nonetheless, not necessarily screaming of a weakening consumer that's falling off a cliff.
All of this informs the other stories we'll be talking about through today. Jackson Hole, the address from Chairman Powell on Friday, the retail numbers, the revisions to payrolls later on this morning. Let's wrap all of that up. This Federal Reserve thinks the labour market is strong, and because they believe the labour market is strong, they believe they have time to get this right when it comes to inflation. They have reason to be patient. This is why 10 a.m. is important. Just how strong is this labour market? Now, we've had 2 guests granted, one from Apollo and Nuveen, who say that these numbers, these revisions aren't important to financial markets, or maybe won't be. Economists are taking a very, very different view of things over at Citi. This is what Andrew Hollenhorst and Citi just published. They're expecting downward revisions to payrolls of roughly 500,000 to 700,000. And they think that a notable downward revision is another confirmation, Lisa, that the rising unemployment rate has been more an accurate signal of labour market dynamics this year than maybe the signals that we're getting from elsewhere.
These are big numbers. It's hard to put them into perspective, which is the reason why I note that a revision of more than 501,000 jobs taken out of the tally through March really would be the biggest going back 15 years. When you take a step back in 2022, it made a big difference when we saw those revisions change. And it highlighted this much more robust labor market than the initial data that we got on a month-to-month basis would suggest. What this meant was that the Fed was behind the curve, and that was the reason why they had to hike rates so aggressively. Some might argue, and you could argue the legitimacy of this argument, that the Fed, if things get revised in the other direction, is working with a shorter time frame, just simply because the labor market didn't have as much momentum in it as it initially was reported to have had.
They always talk about the totality of the data. You mentioned the title of this year's get-together in Jackson Hole, Wyoming, reassessing the effectiveness and transmission of monetary policy. Wouldn't your assessment as you reassess things be very different based on whether jobs are a million or a million lower or not?
Well, this goes back to waiting for Godot, right? The long and variable lags. And if the numbers get revised lower by enough, well, hey, Godot was there all along. He just wasn't seen. And that, I think, is the real concern for a lot of Federal Reserve officials. The tone has already shifted. This is going to be a Jackson Hole that will really open the door to a 25 basis point rate cut, potentially even more in September, and then continue gradually adjusting. Whether this is the good kind or the bad kind is what we have to see, and how it affects risk assets. That's the bigger question I think people are looking for.
Without a doubt, we're both on the same page. That's the critical question when it comes to risk assets. Risks look okay right now. If you're looking at the S&P 500 up by about 0.1%, risk assets doing all right. That's the equity market. In the bond market, pretty stable and range-bound in the bond market, particularly the front end of the curve over the last few weeks. The whole curve shifting lower yesterday, but really no drama, and no drama again this morning. The 10-year at about 381. At various points along the curve, Lisa, we mentioned it earlier, actually trading near the lows of the year for some of these yields.
As people maybe start talking less about a neutral rate that is around 5%. Remember when we were talking about maybe the neutral rate actually is where we are right now. Many fewer people talking about that as inflation does normalize. Key question that I have is, when do auctions start to matter a little bit more? We do get a 20-year auction today at a time when we do have the lows of the year on some of these longer-term bond yields. Does that reset it? Do we start talking about some of the deficit, et cetera, or does that continue to be in the back burner?
All of that still to come and a whole lot more. Coming up on this program, we'll catch up with Sarah Hunt of Alpine Saxon Woods as the S&P 500 snaps its 8-day winning streak. John Lovallo of UBS as Toll Brothers sees a spike in demand for luxury homes, and Veronica Clark of Citi on her call for 100 basis points of cuts before the end of 2024. We begin with our top story. Stocks taking a bit of a breather this morning as traders await jobs revision data and Fed Chair Jay Powell's address this Friday. Sarah Hunt of Alpine Saxon Woods saying the following: we now seem firmly back in Goldilocks territory. Data on the labour market and jobs number revisions may yet mar that picture, and we do have more labour data coming in early September to either reinforce the start of the rate cutting cycle or throw a curveball. Sarah joins us for more. Sarah, are you expecting a curveball or some reinforcement?
I think that the consensus seems to be that those labor numbers are going to be revised down. How far down is going to be the question. And then that becomes the argument that Lisa was just making, which is, was it really never that good to begin with? And we were trading off the idea that it was so much better that we had to keep rates higher for longer. I think that the number that came out in early August was part of the swoon that happened, which is almost completely forgotten at this point because it was so quickly retraced. And I think that if that is the case and people really were worried about that, or if that was just one of the proximate things that happen at the same time, if the numbers are weak, I think that's going to be a problem. I think people are really going to start to go back into, we're going to have another complete turnaround, and all of a sudden it's going to be recession watch, oh my God, hard landing, from what we just experienced 2 weeks ago, and now we're back to, no, it's fine, feather soft, it's all good.
Do you think we're that vulnerable? Because we heard from Nuveen, we heard from Apollo, and they say maybe this number won't matter that much to financial markets. Do you disagree with them?
I disagree just in the fact that we have so little knowledge. We don't know what's going to happen on the geopolitical front. We don't know what's going to happen with the election. If you get something that's a big enough revision down, I think the market absolutely will pay attention because it's been swinging back and forth on narratives, on different data points, because that's what the Fed has been telling it essentially to do. So I think that those numbers do matter. If they come in lighter, then they won't matter.
What matters a lot is what companies are telling us. And right now, what companies are telling us is that they're able to expand profit margins even as they reduce prices for consumers. This doesn't speak of a weak labor market going forward, because a company that has a bigger profit margin might not be looking to lay many people off. How much do you take more of a message from that than you do data that may get revised pretty significantly?
Well, I think that that has been one of the surprises on the earnings front, is that margins have not been affected. And I think that there was some concern that as inflation came down, margins would come down. And this goes back to the corporations will adapt, right? Which is what Tom Keene says all the time.
TK's favorite line.
Yes, and I think that that's one of those areas where that they've managed to keep margins up has been a pretty good sign. It's been very helpful for earnings. It's been very helpful for the stock market. But at some point, those margins and wages start to argue with one another. And the question really becomes, as wages have not grown as fast, if you start to see revisions down, then you start to see some real weakness in that part of the market. And it's clear that the lower end consumer is already having some issues, and that maybe what Target is experiencing is some trade down, as is maybe some of the Walmart numbers. So I think there's a real question as to how that different segments of that market are going to act and continue to react.
I love this phrase that you wrote, blushing pessimists, because the pessimists have been wrong again and again and again, and now are left with egg on their faces. Given the potential for downside risk, how much are you positioning for that versus just going fully into risk with this idea that the Fed will be cutting rates, that there is plenty of cash to be unleashed from money market funds, and that things are okay?
Well, we do have we have broad-based portfolios, right? So yes, we are participating in the technology, but we're not 100% into technology. There are other parts of the portfolio. The equal weight S&P has finally started to pick up its head this week as well. And I think that if you are comfortable where you're positioned, you have to, the risks of the market are just there. I mean, you don't know, there could be an exogenous shock. You don't know what's going to happen. So you have to be comfortable enough with your positioning to say, okay, if this is a bigger, broader economic shock, am I okay with this, as opposed to this is a sector shock and I want to stay away from those sectors. So you have to be, it's a combination of how you put those portfolios together. But there is, I think, some risk in the market just from a valuation standpoint. But I think that if we got some good information going into 2025, then people are going to start to look to that year anyway. But we have a lot of things in between now and then.
Conviction longs for you. You mentioned the equal weight, record high on Monday. What are the conviction longs for you at the moment?
Well, I mean, we still participate in the big technology stocks. You kind of have to. I don't see how you can't, since they're the companies that are spending the most money and have the most cash. But if you look at some of the areas, I know that we've talked about energy over and over, and then if there's a recession, you're going to see some problems. But you are finally coming to the realization that conventional hydrocarbons are not going away in the next 15 minutes. And I think that that has put that back in an investment class where you've got some very good returns on investment now. You've got some very good dividend yields. There are places where you can feel more comfortable. And I think that those are you look at both sides of those equations.
So the haven, the downside risk, is it $1 million gold bar that's hard to lift?
Well, I'm not going to lift those weights at the moment, but I do think that there's nothing wrong with looking at all the different asset classes, and certainly the fact that gold has continued to do well in both adverse and non-adverse circumstances over the year, I think does say something. I think it says more about what central banks are doing, but I think that there is some concern that the currencies globally are, fiat currencies are, compared against gold, they're going down, right? So I think that there's a reason why people use that in portfolios, and those mining stocks have finally picked their heads up too. They were not tracking gold, and they have finally started to.
You know those old-fashioned gold heist movies where they're just sort of throwing around gold bars like they're nothing, 400 ounces?
So fake.
It's ridiculous.
Absolutely awful.
Can you imagine how many could you actually carry out of the bank if you were to deliver an old-fashioned gold heist? How many do you think you could carry?
Easy.
Hardly any.
Yeah.
I mean, I don't know how many I'd need. Like 10's the retirement package, right? You
Yeah.
need sort of 10 if you carry them out of there.
Yeah.
I'm not suggesting anyone does this.
Is this where your mind goes, the retirement package?
They're so heavy.
How many could you actually carry? But it's true. They just sort of throw the bag over their shoulder.
Like just tossing them to each other.
I love those heist movies.
I know, same. They need to bring some back. Sarah, thank you. It's good to see you. Sarah Hunt of Alpine Saxon Woods. Let's take the opportunity to get you up to speed on some stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Ford is pulling back on its electrification strategy yet again. In an announcement moments ago, Ford said that it's canceling plans for a fully electric SUV, which may cost the car maker about $1.9 billion. Ford will also postpone a next-gen electric pickup and reduce spending on EVs to 30% of its annual CapEx. It was 40% previously. CEO Jim Farley told Bloomberg in an interview that the pullback was in part to make sure that there are affordable vehicles that meet their criteria of profitability when they do launch. Target is surging in the pre-market this morning. It is up 13.8% after ending a string of sales declines in the second quarter. They cited improved discretionary spending. TJ Maxx, you see there, also up in the pre-market, 3.6%, reported second quarter net sales that beat estimates. They said the growth was driven entirely by customer transaction. On the other side of things, there is Macy's down 6.7%. It cut its outlook for sales for the rest of the year. Revenue in the last quarter fell just shy of estimates. The company said, quote, challenging consumer environment contributed to the weakness. Texans have set an unofficial record in electricity use. According to the Electric Reliability Council of Texas, air conditioner use yesterday pushed the power grid above a record set last August. Parts of the Lone Star State experienced dangerous conditions as the heat index soared. And that's your brief, John.
Danny, thank you. More from Danny again in about 30 minutes' time. Up next on the programme, we'll get you some morning calls and we'll catch up with John Lavallo of UBS as Toll Brothers sees continued demand into 2025. That's just around the corner from New York. This is Bloomberg.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
The opening bell is 1 hour and 14 minutes away. Just to work through some of the price action for you. Equity futures positive by close to 0.2%. Pretty stable in the bond market, 381. Plenty of big moves in retail. Target absolutely ripping in early trading going into the opening bell. The numbers much better than expected. It's a return to growth. So a great start for the retail earnings a little bit earlier on this morning. Not so great for the likes of Macy's, Lisa, and that struggle being explained away throughout this morning so far.
Talking about how there is a more constrained consumer at the same time that you hear something very different from Target. At the same time, this comes from sales coming in lower than people expected. Even though they were able to eke out a bigger profit, this is a question of getting people in the doors at a time where there are questions about Macy's competitive edge.
Yeah, in the door at places like Macy's, not happening in the same way. They're talking about better store traffic, by the way, at Target. That's what they're talking about this morning.
Precisely, including comparative sales, which is the reason why the shares are increasing so much. Not the same story. Fewer sales when you take a look at the likes of Macy's.
Very different. One to watch, a theme to watch going into the opening bell. Let's get you some morning calls. First up, Citi opening a 30-day positive catalyst watch on Gap. The analyst anticipating a big second quarter profit beat and upbeat sales guidance when the retailer reports next week. That stock is up by 3%. Next up, Bank of America downgrading American Express to neutral with a 263 price target. The analyst pointing out commentary from retailers and travel companies that points to a challenging spending backdrop. A stock is down by 1.2%. And finally, UBS maintaining its buy rating on on Toll Brothers. Alice John Navallo saying that there's a lot to like in the home builders' latest earnings report, noting that an upwardly revised forecast should overshadow a miss on orders as Toll expects continued demand. Their stock is up by about 1%, and John's with us now. John, I've been looking forward to this, so thank you very much for joining us, sir. I want to dive straight in, but take a big step back at the same time, because I want to talk about the bigger theme around the home builders for the last year or two. John, how they've done so well, how they've thrived in a high interest rate environment. Can we start there, the factors behind all of that?
Sure, Jonathan, thanks for having me. It's a very interesting dynamic out there for the home building industry and the public home builders specifically. To your point, existing home sales have been lackluster. There's been a lock-in effect where folks are just reluctant to sell their homes because they have a 3.5% mortgage or whatever the case may be. What the public builders have been able to do very effectively is buy down mortgage rates and offer other incentives that make the affordability equation work for a broad range of buyers. And so they've been able to kind of step in and fill the void where there's just been no existing home inventory. So that underlying demand has to go somewhere, and it's going towards new construction, and the public builders are really kind of taking the baton.
John, one question we have is what it would take to unlock some of that inventory to boost supply just a little bit more. And I know you've noted this in your research, but I just want to go through some of the numbers for our audience who maybe don't follow it as closely. The effective mortgage rate in this country is something like 4%. So that's the average rate on outstanding mortgages. The market rate, if you wanted to go and get a mortgage right now, would be something a little south of 7. So that's quite a wide spread at the moment, John. And as you've noted, and everyone in the industry has noted, that's why inventory has been so low. John, how tight does that spread need to be to start to encourage some of those properties to come back on the market?
Yeah, sure. I mean, let's put a finer point on it. 80% of mortgages are below 5%, 60% are below 4% in the U.S. So that bar is fairly low. That being said, as we know, life goes on, Jonathan, right? And so I think even if rates were to stay at current levels, at some point, folks are going to adjust and their transactions are going to pick up. And we need that to happen. The existing home market is essentially dysfunctional at this point. It's frozen. We're at under 4 million units. That should be closer to 5.5 million units. And remember, at the other end of an existing home sale, there's typically a home purchase, and that could be a new home purchase. So it's not a zero-sum game here, and it's not a death knell for the home builders to have that inventory come back. So long and short, that inventory will eventually come back regardless. But I think that as rates trend lower and we start getting a little bit closer to, a 6 handle on the prevailing rate, that's going to be pretty helpful.
So this is the 30,000 picture view, which is frankly what a lot of people are focusing on in the political season, as well as just trying to understand when they can buy homes. Drilling into the likes of Toll Brothers, how much is this a story of a company that caters to higher end consumers that have the capacity to buy a home in a way that the vast majority of people, or most of certainly people who don't own homes, are struggling?
This is a great question, Lisa. And look, I don't think it is that case. I think you're absolutely right. Toll is the premier luxury home builder, and they are the build-to-order builder that's been doing this for a very long time. However, what's been so unique about this cycle is the builders have all adjusted, including Toll. Toll is now delivering 50% of units, 50%, that have been started on spec. So actually, production has started before there's a buyer in place. That's a strategy that has historically been used by kind of lower-end, entry-level, first-time buyers. And about 45% of their portfolio is geared toward what they call affordable luxury. So yes, that higher end buyer has been more resilient, but Toll is really kind of playing through the entire curve of buyers, which has served them incredibly well.
How much is this really a broad story versus a Toll Brothers story? And I say this because home building starts actually have fallen. We have seen actually fewer home builders start to expand, and we're seeing some more modeled performance from a number of other players.
So Toll put up a great quarter, so I don't want to take anything away from them. But this is really a story of public home builders, right? Builders with balance sheets, size, scale, and the ability to outperform their smaller peers, which are about 50% of the new construction market. And by the way, the existing home market just doesn't have the inventory to cater to the demand. And so it's really a function of the public builders stepping in, taking advantage of the situation.
John, how closely are you listening to some of the rhetoric on the political sphere about $25,000 incentives to allow first-time home buyers to make down payments? Do you think that this signals some sort of policy shifts on the burner? And two, do you see this as really highlighting some of the vulnerabilities for home builders at a time when their industry is very much front and center from a political perspective?
It's a great question. Look, there's no question at all that affordability, housing affordability, is a huge topic, and it's a huge concern out there. It's a real pinch point for the industry, including for the public home builders. So if there is some sort of stimulus that can be targeted towards helping people get into homes, that could be helpful. You know, frankly, I think that the public home builders would probably prefer the government to stay out of the home building industry as much as possible. But that said, if we can get some stimulus to put a little bit more money in the pockets of folks, that would be beneficial.
John, can I ask you a direct question about how many homes we're actually building in this country right now, whether we're running below average, and what a government could do about it? When you hear a number like, I want to see 3 million new homes built in my term across 4 years, just how realistic are those kind of numbers?
Yeah, you know, our estimates would suggest that we're about 2 to 3 million units underbuilt here in the U.S., dating back really to the global financial crisis. The challenge, Jonathan, here is that even if the builders wanted to build a lot more, there's just capacity constraints. There's not enough construction labor. There's entitlement and sort of permitting delays at each municipal level that it's just, frankly, would be incredibly impossible to ramp production to the levels I think that would be needed to put that kind of supply into the market over the next 3 years to fill the gap, unless demand were to fall off a cliff and everyone just continued to build. So I don't know, frankly, how realistic those numbers are unless there is a step change in the actual process of getting land ready to build upon, and there was an influx of labor to come in to kind of, to make the process a little bit more efficient.
John, this was excellent. We've got to do it again soon. Thank you, sir. John Navala there of UBS on the home builders in America. We talked about this yesterday. Demand-side solutions, supply-side incentives. The supply side is so much more complex when it comes to this story than it is when it comes to compare, just say, boosting demand, incentivizing demand. One is much easier than the other.
And talking about getting rid of red tape isn't as attractive of a political proposition as, say, $25,000 in hard cash. And that's kind of the messaging parsing that we're hearing. How do you get rid of that red tape when you're dealing with not in my backyard, and you're dealing with different types of permitting constraints? And that's really what John was talking about.
Effort's got to be federal, state, and local. Everyone's got to come together, do it all at once. Ultimately, we talked about this yesterday, it will lead in the near term, and I don't know how long the near term is, to higher prices, right? Demand-side solution, supply-side problem.
If they get this through, which is a huge if considering the composition of Congress, but yes, that is the large takeaway that I've gotten from most people.
Most people, including the people around this table. Up next on the program, Veronica Clark of Citi, Krishna Mamani of Lafayette College, all of that and more from New York. This is Bloomberg.
What's happening on Wall Street?
That couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
60 minutes away from the cash open with equity futures right now. The S&P 500 positive by about 0.2%. Likewise on the Nasdaq, similar move elsewhere. On a Russell, the small caps were doing better here by 0.5%. So looking to bounce back from those small losses yesterday. Lots of data to look ahead to. Jobless claims coming up tomorrow, and we'll get some job revisions later on this morning at 10 a.m. Eastern. We'll talk a lot more about that in just a moment. I want to go through the scores in the bond market for you. The 2-year, 10-year and 30-year shaping up as follows. The 2-year 398, the 30-year down to about 4%. I talked about various points along the curve being near the lows of the year. The 30-year is one of those points, and if you're worried about the mortgage market and interested in borrowing sometime soon to buy a home, the conversation we had about 15 minutes ago might be of interest to you. Just the gap, Lisa, this spread between what the effective mortgage rate is right now, which is basically the average mortgage rate of outstanding mortgages in America, which is something close to 4, and what you'd be borrowing if you went and took a mortgage out today, that spread is still very wide, something like 300 basis points.
Yeah, talking about a 4% effective mortgage rate versus this sort of roughly 7% mortgage rate currently if you were to take that out. Yesterday we were talking with Neil, which I think Neil Dutta of Renaissance Macro. I loved his point, saying stop dismissing the housing market as something of an outlier that's been uniquely affected by the Fed's higher rates. This is emblematic of a situation that is building on itself where people don't afford homes, can't afford homes, and there are distortions that can only get unwound if mortgage rates get down to something like 5.5%.
MBA mortgage applications this morning, that data dropped to 7 Eastern, down 10.1%. Home improvement companies struggling as well. We've seen repeats of this, echoes of this across this sector.
This is the reason why I really am excited about Jackson Hole this year. The idea that the theme is the idea of assessing the effectiveness of monetary policy at a time where they have control over the front end, but not necessarily the long end of the yield curve. That is not where they are focusing unless they start some sort of quantitative easing once more, which is politically a hot potato considering how big the balance sheet already is. This comes at a time where, yes, you have seen calm in the long end of the yield curve, but today we've got a 20-year auction, some $16 billion. Later in the year, we have the potential politically stemming turmoil. How much control do they have over the long end, which is one of the key transmission mechanisms of their policy?
I'm almost laughing, and you can tell.
I can tell.
I'm almost laughing because I'm trying to work out whether you are genuinely excited for Jackson Hole or just trying to convince yourself before you get on the plane later this afternoon.
Okay, look. I think it's always interesting. I think, you know, I am interested in the philosophical discussion around the efficacy of interest rates. Whether that will make good TV, I will let you decide. But I do think it's going to be compelling, and I think these are important debates. No one will give any answers, which also is difficult to really square. I think it's a beautiful place. I'm looking forward to kayaking on Jenny Lake.
The diner's great too. The diner's great too.
The diner is wonderful, and there's some really great people. And to me, to hear some of the ideas is actually very exciting.
That felt a bit more authentic. I'm looking forward to the coverage. It kicks off tomorrow and on Friday as well at 9 a.m. Eastern time, so look out for that.
I hear you're not going.
I'm not going, no. I got out of it this year.
Because
I'm not sure if this is a conversation we should be having live on TV.
Move on.
But yeah, I won't be there. On the surveillance this morning, top stories for you. Two different stories from retailers, Target and TJX, boosting outlooks on the back of improved discretionary spending. Macy's cutting its annual forecast, citing a challenging consumer environment. What is idiosyncratic, what is real, and what is evidence of a real consumer slowdown? Target says no, other companies say there really is one.
Challenging consumer environment, meet off with what we heard from Target, which is the resilient consumer. And this really becomes this question of, do you start to see commentary like it is a tough backdrop as the new weather argument, as the new currency valuation argument? It's basically an explanation for an execution issue. And that, I think, is what you're seeing in the price action. This stock market got a lift after the Target earnings. And you can say it's because it's a quiet market with very few catalysts. But nonetheless, people are taking more of a signal from the resilience than they are from the weakness that we're seeing in the likes of Macy's.
Stocks are picking up on the S&P, up by about 0.2%. I'd like to turn to this story. It's an important one in this country. A federal judge in Texas ruling that the FTC cannot enforce a near total ban on non-compete agreements. The judge signed in with the plaintiff and the U.S. Chamber of Commerce, saying the FTC lacks the authority to enforce such a ban. An estimated 30 million Americans are subject to non-compete agreements. Lisa, this story is actually really, really complex. If you work for a company and you're paid a certain amount of money and you have a certain amount of knowledge as well, and you can just walk away and take it with you and go somewhere else to work, I think you can make the argument that you need non-competes. If you're at a fast food company and you're being prevented from going across the road to go and work for another fast food company, and that's suppressing wages, then we've got a very different problem. How you tackle this issue is difficult. How you work through these problems is quite hard.
How you craft a law to be specific enough to be constitutional is also part of the issue. How do you craft something that is general enough to encompass that type of abusive behavior where you're preventing someone who works at a fast food restaurant from going to another place versus something that seems rather reasonable is part of the reason why courts are having trouble with this. Lena Khan, who is the head of the FTC, is really going to ongoing face this challenge, the idea of how do you get specific enough to avoid constitutional questions about whether this is not a fair, due process of law, whether there sort of could be an arbitrary enforcement versus going after practices that are punitive, that a lot of people would agree are not right.
We should be able to have just objective, rational conversations about something like this. We'll let the lawyers deal with the legal stuff, but just an objective, rational conversation. Do you need non-competes in the food and hospitality business? To the degree that they exist, probably not. Do you need them for high finance and tech when we're talking about company secrets? Likely you do in specific cases.
But then how do you craft a law around this?
With great difficulty.
And that's, I think, what they're facing off with. It's sort of the silver bullet of the policy spaghetti that we keep hearing about, that a lot of these broad sentiment sort of declarations are better in sentiment than they are in actually getting across, just simply because it is hard to craft a law narrowly enough to make that distinction.
That is an ongoing fight, an ongoing story, and we'll bring you the latest when we get it. Let's turn to the latest when it comes to the jobs market. We're looking ahead to 10 a.m. Eastern when the BLS releases its preliminary annual payrolls revision. Wall Street economists expecting the U.S. jobs growth through March was likely weaker than initially estimated, adding concerns that the Fed might be behind the curve. Now, Lisa, when it comes to these revisions, it is anything from 300,000 to 1 million, based on what I've seen from economists on Wall Street, that we might see in terms of a lower revision to payrolls growth over the last 12 months ending in March.
JP Morgan calls for a decline of about 360,000. Goldman Sachs, as you've mentioned, goes anywhere from 600,000 to 1 million jobs that are removed from the overall tally in the year through March. Question is how the market will respond. We had the likes of Torsten Slok saying the market won't care. We have other people saying it could actually very much color how people view the labor market in terms of where we're coming from, and Sarah Hunt was in that camp. We'll see at 10 a.m. Eastern.
Just around the corner, we'll get you more opinions on this as well. Those job revisions could shape the tone of Fed Chair Jay Powell's remarks on Friday in Jackson Hole. Veronica Clark of Citi writing the following: we expect 50 basis point rate cuts in both September and November. But Chair Powell will not want to make any commitments on the exact policy decisions the Fed officials will make in coming meetings. He will remind us repeatedly that these are data dependent. Veronica joins us now. So, Veronica, we need to talk about how dependable that data actually is and the scale of revisions that you're expecting in 90 minutes' time.
Yeah, I don't think I've ever gotten so many questions on these preliminary benchmark revisions to payrolls before. But based on the official payroll data, the QCEW data, which we do already have for 3 of the 4 quarters of this annual revision, it does look like something like 500K, 700K downward revisions to payrolls. I think that's pretty much expected at this point, but that is a pretty substantial downward revision.
So, Veronica, here's the issue. How will people take this? We have some people like Torsten Slok and Anders Persson saying it won't actually matter all that much, considering the strength that you're seeing elsewhere. And then other people saying it'll actually make the labor market look much worse heading into a Jackson Hole where clearly this is a Fed Chair, Jay Powell, who wants to cut rates. Which is it?
Yeah, I think usually these revisions don't matter too much, but they do matter a bit more than usual this year because we've had such diverging signals between all the labor market data that we have. Most importantly, very strong payroll job growth, but much weaker employment in the household survey, that rise in the unemployment rate. And there has been a debate, which one is the accurate signal. And if you were relying on strong payroll job growth and that now looks a little bit less true, it's just looking increasingly like that rising unemployment rate is the better signal for what's happening in the labor market.
Torsten Slok was on the program about an hour ago and he was saying there is no slowdown. There's nothing to worry about here. Veronica, you're looking for some punchy moves from this Fed. 100 basis points across 2 meetings, 50 in September, 50 in November. What does the data need to look like on September 6th for you to sit there at Citi and say, yep, green light, 50, September 18th?
Yeah, I actually think the bar for starting with a 50 basis point cut in September is actually pretty low. I think the issue is it's just been multiple months now where the unemployment rate has been rising. Certainly if we get these downward revisions to previously strong payroll job growth, 1 month of data that, data for August on September 6th is not really going to skew our assessment that there are really asymmetric risks around the weaker labor market. I don't think that's going to, one print alone is going to, give the Fed a lot more confidence that maybe the unemployment rate won't rise anymore. So I think it's pretty easy for them to start with 50 in September.
Why do you think the bar is so low, given the fact that they're not forecasting it in that own statement of economic projections, and you're looking at an unemployment rate that's still fairly low with retailers reporting fairly strong earnings?
Yeah, I mean, the unemployment rate is low, and it has been, and it would be fine if it stabilizes here, but I think just each month we see it not stabilizing. You really are risking, getting to that point of non-linear weakening in the labor market. Once you do start to see things like building job loss, that's really when it's too late, and that's what the Fed wants to avoid. And I think most Fed officials would agree that they are far from neutral here. The cost to starting a bit big and getting quicker back to neutral is pretty low.
So this is the study of economics. Can we do a little bit on sociology as well? Just how this is going to work on the FOMC when they get together for that 2-day meeting on the 17th. Is unanimity important to Chairman Powell? Does he need everyone on side?
I think he does want to definitely build consensus. Maybe you can have one dissent. We do have hawks like Governor Bowman. Maybe something like that is a dissent. But I think, he wants to build unanimity. But I think most people will probably be coming around to that cut. We've even seen a shift in rhetoric after CPI last week. People who are saying we just need a bit more information, a bit more good inflation data. And once we got that last Wednesday, even the rhetoric from some of those hawks has pretty quickly changed.
Well, this is what I'm trying to gauge, just how high the bar is. You say it might actually be quite low, but what I hear from Governor Bowman is maybe I'll consider it. What I hear from Kashkari, another hawk on the committee, maybe I'll consider it. Consider a cut. That's before we even start to discuss 25 versus 50, and it's the 50 piece of it. Just wonder, Veronica, how much of a sticking point you think that might be on the committee?
Yeah, I do think you'll probably see some agreement, of course, depending on that August employment report. That is going to be very important. But I think even if the unemployment rate stays at 4.3%, even those hawks will see that the risks are really asymmetric around the labor market. We've had better inflation data. We've only had worse employment data. The cost of starting a bit big is pretty low. They did that in 2007. They did that in 2001. It's really not unheard of.
Do you think basically that would be a concession that they made a mistake at a time when the likes of Mickey Bowman is talking about it might be appropriate to gradually lower the federal funds rate? We heard the same thing from Mary Daly, the importance of being gradual, of being slow. How much is that sort of a negative signal if they go 50?
I think 50 could even still be considered somewhat gradual. I mean, rates are really high here. We do have them going to 50s, but then slowing to 25s. I think they're obviously, still focused on the inflation side of things, but the risks are just really quickly shifting to the labor market. It's not necessarily a mistake. It's just shifting priorities pretty quickly.
Sticking with 50 over at Citi in both September and November. Veronica, thank you as always. Veronica Clark of Citi. Looking ahead to that Federal Reserve meeting next month, the Jackson Hole address from Chairman Powell and the revisions to payrolls that we get at 10 a.m. Eastern Time. With us around the table, Krishna Mamani of Lafayette College. Krishna, an easy one for you. What happens if Veronica's right and the economy falls off a cliff and the Fed starts to move in 50, 50, and then 25, 25, 25?
So all of those people who are looking for Fed easing to help their risk portfolio would be holding their head and crying. The bottom line is, if they actually cut 50, given what they have already said and what the construction of the FOMC is, that means things have gone really south really quickly. And if that's the case, I think we are in bigger trouble than we think we are in today. I don't think that is the case, and that's why 25 basis points remains my base case. Powell in his last presser basically said we are not even considering 50. And since then, the data, it has kind of gradually softened, but hasn't softened as catastrophically as people want us to believe, especially somebody like Jeremy Siegel looking for an emergency cut. Clearly, that certainly hasn't been the case.
Yeah, I have to say that conversation sounded ridiculous at the time, and it seems even more ridiculous a few weeks later. Krishna, you say the biggest challenge here is valuations, and that you're not encouraged by the vicious snapback we've seen. In fact, you find it unsettling. Can you just walk us through in some detail why?
Sure. So if you look at the basic economic data, it has been supportive for the markets for quite some time. That is, we have decent growth, inflation slowing down, and the Fed on the verge of cutting. So all of that is extraordinarily supportive. But if you look at valuations, whether it's in the credit markets, whether it's in the equity markets, clearly they are very, very stressed. I mean, they're not overly stretched, but they are definitely stretched. And then when we had a correction, and it was driven more by market positioning rather than weaker data, or at least the reaction was far more disproportional relative to what the economic data was, that sort of indicated that the market position is really offside. And if we had kind of stayed there for a long time and come back, then some liquidation of positions would have taken place. Instead, what has happened is we have not only taken back all the positions that we liquidated initially, we have probably piled on a bit more. At least that's my sense. I hope I'm wrong, but it would have been much more helpful if the grind out was slow and steady rather than a real quick snapback.
Let's put these two ideas together. The idea that if the market did get a 50 basis point rate cut, the people who are heavily into risk assets would be holding their head and crying. They wouldn't be sort of celebrating at the same time that you see market valuations as being too high. Are you saying you're getting less constructive on risk assets because the Goldilocks scenario that people are pricing in right now seems implausible?
Well, so I would say that the base case for the market right now, what we are discounting is all in on soft landing. So the likelihood, and it's quite likely that we will probably get it. And in that scenario, it's very plausible that we don't have a significant correction and we grind higher from these levels rather than going lower. What I'm talking about is in a risk scenario where things slow down much more than what we are anticipating today, there's really no margin in the market valuations today. And in that scenario, there'll probably be a substantial correction than otherwise.
Heading into an hour and a half from now, when we get those initial revisions, I wonder how coiled this market is to some sort of really more significant downward revision to the number of jobs created in the United States in the year through March. Are you saying that even a small type of catalyst could create a disproportionate event in the market akin to what we saw last week?
I think the risk of that is substantially higher than it has been in the cycle at any other point, primarily because things are slowing down. And if you corroborate that story with these types of revisions, I think there is a potential for that. I don't really think that. I think revisions became a political question far more. If this wasn't an election year, I don't think we'll be talking about revisions the same way that we are talking about revisions.
You've got to build on that. Why is that? Why do you think it's so important for the politics?
Well, it's important for the politics is because that is being used as a ploy for, somebody is gerrymandering something to demonstrate something. And that gets a lot of traction in social media. We have seen that all over the place. And I think the hoopla is more about that than it is that revisions are going to be 300,000 or 400,000 or 1 million. That it has happened, throughout for a very long period of time. And I think for employment, what is far more important is not the absolute number. It's really more the trend.
What is the trend?
The trend is the labor market is slowing, but not slowing as catastrophically as some of the bears would have us believe.
We need to have a decent idea of what normal is supposed to be to sort of benchmark that. What do you think normal is?
I think 150,000 is probably a good normal number.
Okay.
And if we get that, and unemployment rate may tick up a bit, but I don't think that is slow enough for the Fed to kind of, having said that they're not considering 50, for them to consider 50 as a result.
We've heard a few times from people that the Fed is offside, and maybe offside by as much as 100 basis points already, perhaps even more. Listening to you, you're a little bit more constructive versus some of those voices. How offside do you think the Fed is currently versus the 5.5% we're at?
Well, so I think if the question is the Fed, have they delayed the rate cuts for all sorts of pressures that they have faced over the last 2 years? The answer is absolutely they have. If they hadn't missed the boat the way they did in 21, I think we would be further along in the rate cutting cycle than we are. And that's a historical legacy. That's a baggage that we have to accept and deal with. It's never about what the Fed should do. It's what the Fed is going to do and what they are telling us. And we should take them at face value, is that, yes, we will cut, but we'll be very methodical. And if the data gets us really scared, we'll cut more expeditiously. But that's not the case today.
There's a lot of people listening to this just sort of doing this, nodding their head to Krishna as he speaks. Krishna, thank you. Krishna Mamali of Lafayette College. Appreciate it, sir. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Hamas and Israel are still divided over an American proposal to pause, if not permanently end, the war in Gaza. U.S. Secretary of State Antony Blinken met with Egyptian and Qatari officials yesterday. He reiterated that Israel has agreed to what the top U.S. diplomat called a bridging agreement that would create space for the two sides to hammer out the details of a ceasefire introduced by President Biden in May. He said it's Hamas's turn now and time is of the essence. Uber has hired a former Tesla executive to oversee the company's transition to electric vehicles. Rebecca Tonici will start next month as the global head of sustainability as Uber aims to use zero-emission vehicles for all of its rides and deliveries by 2040. At Tesla, she helped open the car maker's charging network to other brands. Speaking of EVs, Ford is pulling back on its electrification strategy yet again. Earlier this hour, Ford announced that it's canceling plans for a fully electric SUV, which may cost the car maker about $1.9 billion. Ford will also postpone a next-gen electric pickup and reduce spending on EVs to 30% of its annual CapEx. It was 40% before. CEO Jim Farley told Bloomberg in an interview that Ford wants to make sure cars launched fit their criteria of profitability. And that's your Bloomberg Brief. John.
Danny, thank you. Thanks for this morning. Up next on the program, setting you up for the day ahead. And we'll touch base with Anne-Marie at the DNC in Chicago. All of that and more. Up next from New York, this is Bloomberg.
Who is the Vivian Tom clientele? Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, so they feel that the power, the energy. So now they come back to the store and they buy more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The opening bell about 37 minutes away. Equity futures positive by 0.2% on the S&P. Your trading diary for the week ahead. Your calendar looks like this. At 10 a.m. Eastern this morning, we get the annual payrolls revision. So much more focus on this time around. Followed by Fed minutes at 2 p.m. Eastern. Thursday, another round of jobless claims plus US PMIs. And Jackson Hole and the annual Fed get-together begins. On Friday, we get the main address from Chairman Powell. Turning to the other main event this week, the DNC continues in Chicago. Tonight, we'll hear from Kamala Harris's running mate, Governor Tim Walz of Minnesota, and tomorrow Harris will deliver her acceptance speech. Anne-Marie joins us now from the DNC in Chicago. AMH, walk us through the next 24 hours.
Well, Jonathan, we're going to be hearing, as you mentioned, from Governor Walz. This is really a moment for him to introduce himself to the American Republic. Remember, this individual is not known by most of America. He was a congressman, he was a governor of Minnesota, but he didn't have that national appeal the way he does now. So we're going to hear a bit from him, and he's come under fire for things like potentially insinuating some of the fertility uses his family went through to build their family, as well as his military record. So potentially we'll hear a little bit of that from him today. We're also going to hear from Speaker Nancy Pelosi, and I'm really interested to hear what she has to say. In many ways, this convention is the way it is because of her, because of the pressure she put on President Biden to drop out, because the concern she had about what him on the top of the ticket meant for those individuals in the House seeking re-election or the Senate. And yesterday when Governor Newsom was closing out the roll call in California, he said he came from the great state of Nancy Pelosi. So I want to hear what she has to say. And then, of course, all eyes will be on Chicago Thursday evening when Kamala Harris accepts the nomination officially, really a coronation here in Chicago. And at the same time, Donald Trump will be at the border trying to distinguish himself in terms of policies between what his campaign looks for in a Trump 2.0 versus what the Democrats are vying for.
Looking forward to your coverage with the rest of the Bloomberg team. Anne-Marie on the ground in Chicago at the DNC. All of that still to come, plus our coverage of Jackson Hole, Wyoming, and the annual Fed get-together. Bramo heading to the airport in about an hour's time.
Pretty much. I actually think this is actually going to be very important. And I understand we've been a little tongue-in-cheek because they're not going to basically come out and say we're going to cut by 50 basis points. Nonetheless, the key question of understanding the long and variable effects is key, central to this market. And frankly, expectations of rate cuts has been what's been fueling this incredible rally that's left stocks near their all-time highs.
I'll be holding down the thought. And here's the lineup. Matt Hornback of Morgan Stanley, Sam Stovall of CFRA, Aditya Bharve of Bank of America, and Mohammed Al-Aaron of Queen's College, Cambridge in the studio. We'll speak to Mohammed for the best part of 90 minutes to work through some of these major issues. It all comes down today, apparently, the fate of this market in the hands of revisions at 10 a.m. Eastern time. Lisa, which happen quite often, but this time, this year, seems to be a much, much bigger deal for a lot more people.
Well, Krishna Mamani is saying that it's somewhat political in terms of gerrymandering and other situations. There is a lack of credibility in some of the data in terms of surveys not being as well responded to. And that, I think, is underpinning some of these revisions.
The Fed talks a lot about data dependence. How dependable is that economic data? 10 a.m. Eastern time, the next stop for this market. The opening bell about 34 minutes away. Equity futures positive 0.2% from New York. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station. and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
There are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
All right, we got a tale of two retailers today. 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Shanali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, we're going to talk about that tale of two retailers. Target swings to sales growth as Macy's cut its forecast.
And Ford, once again, reining in its EV spending, canceling plans for a fully electric SUV that may cost the automaker nearly $2 billion.
And markets drifting before data revisions that could wipe away 1 million jobs. That report has the potential to shape the tone of Powell's speech at Jackson Hole. That's coming out at 10 a.m. But let's take a look at where markets are trading about 30 minutes to go until the cash trade begins. You can see we're a little bit higher after ending a little bit lower yesterday. The S&P 500, the NASDAQ 100 up 1/10 to 2/10 pre-market. You take a look at the bond market, all quiet there as well. 10-year yields pretty much unchanged, Matt, but we do have a lot of data points to get through today.
Yeah, as you mentioned, the drop yesterday, not large. The profit taking not ferocious. Take a look at this chart, and you can see that down at the bottom in this panel is volume. It was the lowest volume for a sell-off so far this year, so not a lot of conviction behind those sales.
Ferocious. I like that, Matt. We're going to talk about another ferocious move here with Ford. One stock we're watching ahead of the open. And investors like Ford here biting the bullet. Stock up more than 1.5%. The automaker is scrapping plans for an all-electric SUV. It could cost Ford nearly $2 billion. And the car maker is also reducing spending on EVs, Matt.
Yeah, I think investors are very happy to see Ford now spending 30% of its CapEx on EVs rather than 40% previously. So taking down that spend, obviously they're going to have to take a charge for that. I think $400 million charge and then $1.5 billion of extra costs to move production around. But still something that investors seem to be embracing today.
Yeah, and remember, Ford had forecast that its EV unit would lose as much as $5.5 billion this year. So kind of makes sense that you're seeing that stock reaction. Maybe that number will get a little bit smaller. But of course, as Matt and Shanali mentioned, we're tracking retail results as Target and Macy's diverge. Let's get some more now with Bloomberg's Abigail Doolittle.
A tale of many stories within retail, Katie. And take a look at the shares of Target, absolutely surging, up 15.5%. Apparently that Target feeling is back. Now, they beat adjusted earnings, putting up $2.57. That was 18% better. But probably the bigger story beyond that margin, holding on to their margins, is the fact that same-store sales comped up 2% for the first time in 5 quarters, breaking that string of contractions. They also boosted their full-year view, making all of this very interesting. Discretionary spending, very, very strong. Again, that Target feeling. But they lowered the prices on about 5,000 staples, and that was a big draw for consumers to come in, yet maintain the margin. So really a great quarter and outlook for Target. Turning to the shares of TJ Maxx, also we have strength there for that treasure hunt. They boosted their full-year view. Not so much for Macy's, down about 10%. Really pretty ugly here. They took the view lower than what had been anticipated. They're saying it's a very challenging environment, that on the one hand you have their competitors discounting goods, and then on the other hand, consumers really pretty cautious. So this difficult story that we've seen for quite some time for Macy's continuing. And then finally, Walmart. These shares are popping, up about 0.7%. They did sell a $3.6 billion stake in JD.com, the Chinese e-commerce seller, down 7.7%, Matt, on this news. This is the worst day of the year, the worst day since October 12th. So lots of interesting stories within the retail space to take a look at today, and also different stories, different tells, yet again, on the state of the consumer.
Yeah, absolutely. Although they're all saying, I think, that the consumer is a little bit more cautious here. Abigail Doolittle, thanks very much for that. Joining us now at the desk is Tony DeSpirito, Global CIO of Fundamental Equities at BlackRock. Tony, great to have you in the building with us. Thanks for coming to visit us on set.
Great to be here.
What do you think about, I mean, all of these reads are a little different, right? Target, obviously investors are happy to see a return to sales growth. Nonetheless, it looks like even there, consumers are discerning.
Yeah, I think that's the right word. Consumers are more discerning. But when we have all these individual companies, but really if you just look at the macro data, retail sales for July, quite positive. And I think that tells a very nice story that the consumer is still healthy. Consumers still have jobs. We're not seeing layoffs. I think the economy is in decent shape.
Is that enough, though, for the benchmark indexes? I mean, I'm looking through your notes. You spend a lot of time talking about the concentration of these indexes, which by and large, I mean, trillions of dollars track them. You think about the tech wobbles that we've seen, even with consumers still healthy, maybe some of that broadening out coming back into the marketplace. Feels like you need tech here.
So a couple of things. One is the wobbles we've seen in the market, I think, are very much technically driven. Whether it was extended positioning going into this, very light volumes, it's August, July, low participation, the yen carry trade breaking down. I think it's very technical oriented. In terms of the market broadening, this is what we've been talking about for some time. We've been expecting more volatility and more breadth in the market. If you look at earnings estimates for the Mag 7 versus the rest of the market, extreme outperformance for Mag 7 in 2023. As we go through 2024, those earnings growth rates start to normalize, and basically they're neck and neck by fourth quarter. I think that's a healthy sign that the market's going to start to broaden.
Tony, something I'm really interested in is when you look at the biggest fund that you're associated with here, actually none of the top 10 names are one of those Mag 7 names. How do you play the broadening here? When you think about the dispersion in the market, where are you placing your biggest bets?
Well, the fund I run, Equity Dividend Fund, is really set up well for this broadening. It's a value fund. And I think one of the things, there's been a lot of ink spilled about the concentration of markets, right? 3 stocks make up 20% of the S&P 500. That's unprecedented. Some of the implications are that the market, the S&P 500, we think of it as a core index. It's really become much more of a growth index. And that's why it has a higher multiple, but that also makes the index more volatile. I think it's really important that investors think about diversifying their portfolios, and the way it diversifies through value. What's interesting is you can't get that done through an index. Even the value index, the Russell 1000 value, has become more growthy and core over time. And so you really need to find an active manager who's stuck to a value discipline.
So how do you do that? I imagine you put together an ETF for that purpose.
We do. We recently launched our first value active ETF, BLCV. And it's really designed to be very accessible, very liquid. We launched that about a year and a half ago, and it's had great results.
Doesn't value though continually head fake? I mean, we keep saying like, oh, now it's time for value. It's like active versus passive. It always turns out to be not the case, at least in the past decade.
Yeah, I was going to say, look at the 50, 100 years of history tells you value investing is quite strong. And actually, I just celebrated my 10th anniversary at BlackRock, and one of the interesting thank you, appreciate that. One of the interesting things I think over my 10 years, if you look at the returns to value investing, about 8.5% per year over that 10-year period. Right in line with kind of what you'd expect. What's been abnormal is how well growth stocks have done. And that's part of this whole concentration effect. So it's not that value is done poorly, it's just that growth is done super well over that period of time. History tells you that'll mean revert.
So you got to zoom out, is what you're saying, basically, on the chart. So, of course, the notion of how to avoid value traps, that's a big conversation. But to this idea that when it comes to the benchmarks, maybe they're not the best method of investing here, I want to talk about how that logic applies to small caps, because this is a conversation we've had several times over the past month and a half, that you take a look at the Russell 2000, which a lot of people use to gauge small caps. It's gotten junkier and junkier, that you're getting a lot of zombie companies, so to speak, when you invest in the Russell 2000. So how do you think about the small cap universe?
Yeah, so I agree with you totally, right? The valuation gap between large caps and small caps has grown, but so too has the quality gap. 40% of the Russell 2000 is unprofitable companies. Wow, that's unprecedented, right? And so I think what's more interesting than kind of the small cap versus large cap debate is kind of within large caps, it's mega versus large, right? Think about it, we've got these $3 trillion companies, but if you kind of think about a $150 billion company, that's still quite large, still well above mid-cap, and yet the opportunity for a $150 billion company to double to $300 billion, that's a lot easier than going from $3 trillion to $6 trillion. So what I think is interesting is sort of run-of-the-mill large cap, and that goes to the point of the broadening of the market. I think that's where the real potential is.
Well, that's what I was wondering, too, whether size is a factor that you should be paying attention to right now, or if you're trying to play the broadening, should you be doing it at the sector level within the large cap space?
Yeah, I think the latter is the way to do it, sector level within the large cap space. If you think about, go back to the Russell 2000, the market cap of the Russell 2000 is equal to one company, the largest company in the S&P 500. Again, unprecedented. It really shows you how this market has really become quite the barbell. I think playing in the center of that market cap, 150 billion or so, is the right place to be.
Tony, we started this conversation about the consumer, the divergence you're seeing, and really we have later in the show at the 10 o'clock hour, those payroll revisions. A lot of people are worried about the economy, the real strength of the economy under the surface. Even those value names, how levered are they to the consumer and any potential recession?
So that's what's interesting. There are a lot of quality defensive companies in the staple sector, in the utility sector, that have been on sale. And so, as the market has risen, 17% or so this year, a lot of defensive companies have been left behind. So value is not necessarily cyclical. And you see that in the equity dividend fund. Our beta is about 0.95, for example. So definitely not cyclical.
I want to just wrap this all up because you talk about, active versus passive or value versus growth. And for the last 10, 15 years, it's been passive, it's been growth, but it's also been, 5% was high for interest rates over the last 10 years, and historically not. Historically, when you see the Somme rule triggered, we're in a recession. Historically, when you see the yield curve inverted, we're headed towards a recession or in one. So is that mean reversion going to happen now? Is now the time for us to get back to normal after this weird, decade and a half that we've had?
Yeah, so I would separate two things, stock market from the economy. So I think the economy post-COVID is definitely very different. And that's why some of these rules like inversion of the yield curve, Somme rule, haven't been working. And what we've seen is a lot of push-pull related to the recovery from COVID that's kind of created almost mini recessions, rolling recessions by sector. We saw that in the tech sector in 2022, today in the housing sector, right? If you look at housing turnover as a percent of housing stock, it's bumping along like all-time historic lows.
Well, but money has been free for a decade, right?
Yes,
and now it's not.
Yes, and so Now that's where I think we get back to a more normal stock market, right? Is money is no longer free. Volatility should go back to historic levels, and I would think stock behavior should follow that.
All right, inching our way back to normal. That's a good place to leave it. Tony, great to see you. Hope to see you again soon. That, of course, is Tony DeSpirito of BlackRock. Let's take a quick check on futures right now. We're still camped out with mild gains pre-market. The S&P 500, the NASDAQ 100, both about 0.2% higher pre-market. Small caps leading the way. The Russell 2000 currently up about 0.6%. Now, coming up, as investors await Fed clues, we'll speak to Diane Swonk about her expectations ahead of Jackson Hole. This is Bloomberg.
Principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been both based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is high interest to look at what's making headlines around the world. After 2 days of search and rescue efforts, British tech entrepreneur Mike Lynch, his 18-year-old daughter, Morgan Stanley International Chairman Jonathan Bloomer, and 3 others are feared dead. Rescuers believe 6 souls are still aboard the sunken wreckage of the sailing yacht Bayesian, located off the coast of Sicily. Troubled LA-based investment firm B. Riley was a self-proclaimed leader in so-called baby bonds for retail investors who wanted bite-sized pieces of debt. In recent years, the firm was selling those bonds for as little as $25 per note. Now, because those securities are low on B. Riley's list of repayment obligations should it go bust, many of those baby bonds have lost half of their value and now yield as much as 50%. Barack and Michelle Obama delivered blistering critiques of Donald Trump while painting Vice President Kamala Harris as heir to their historic political legacy in addresses that capped the second night of the Democratic National Convention.
I want to know, who's going to tell him that the job he's currently seeking might just be one of those black jobs?
But even as the 44th president electrified the crowd gathered in his hometown arena, describing the Harris-Walz campaign as one of joy and hope, he warned the election will be a fight down to the wire. Shonali?
Now, Matt, stocks are edging higher as investors await an annual review of U.S. jobs data as well as Fed meeting minutes for further clues on rate cuts. And joining us now to discuss that path ahead, Diane Swank, Chief Economist at KPMG. And you think about how investors have reacted to everything we've seen around the consumer, fairly sanguine, yet a lot of worries about this job market, a lot of worries about those payroll revisions that come out in less than an hour's time. What is your big picture read on kind of the softening here of this economy?
Well, I think what we're really seeing is what the Fed had wanted to see, and that is a consumer that is defiant but not defeated. And that is, and in that you see discounting take place, and they show up when discounting takes place. That is what the Fed sought to do with a soft landing. Now, the issue is how far do we get in that process before you start to narrow margins enough? And we did see a narrowing of profit margins in the PPI for the month of July. How do you not get to that edge and see a slowdown in employment that's more of a problem for the U.S. economy? We've already seen the pace of hiring, according to the job openings and labor survey turnover, that has slowed to its lowest level since April 2020. So there's not a lot of room here, even though layoffs are still low, to even accommodate those people entering the labor force without pushing up the unemployment rate, let alone if we were to see a pickup in layoffs. So the good news is the economy's been resilient, but the Fed's job is to keep it there now, and we saw that pivot in Jay Powell's testimony in early July to more evenly weight the full employment side of their mandate with the price stability side of their mandate.
Right, Diane, and that concern really explains why we're also laser focused on these revision prints that are coming at 10 a.m. Certainly the most focused that I can recall in recent memory, but of course, talk to us about that softening labor picture. You have inflation steadily coming down and now closer to the Fed's 2% target than it has been in a while. And you've started to see a lot of people come out and say that the Fed should cut by 50 basis points in September, not so much to ease policy, but just to normalize things. When you think about rates north of 5%, what do you think that they should do in September, and what do you think that they will actually deliver?
Well, what they actually deliver, they get the luxury of not having to forecast themselves and actually reacting to the data as it comes out. They'll be looking at the August employment report. They'll be looking at the August CPI that comes out. Before that, we already know the PCE index from the preliminary data on July is very good as well. So all of that will go into their decision making. I want to see in the minutes today how seriously they talked about a July cut. We know that came up. Chairman Powell made that point at the press conference, and the question was, how serious did they really weigh a July cut? My own view is that if they did a 0.5% cut in September, they could certainly have a dissent, and that would get exactly what they wanted in terms of messaging to the markets, that it was a catch-up to July, realizing the economy is ready for it, but it's not a panic reaction. If you have dissents, you can then calibrate what you do in November and December.
It's interesting if you look at expectations, market expectations, Diane, for the next 5 Fed meetings. Previously, the market was looking for cuts at, 2 or 3 or 4, and now the market is expecting cuts at every single one of the next 5 Fed meetings. Is that really necessary with such strong GDP growth, with unemployment at 4.3%, especially if, we slow down immigration, which tightens up the jobs market a little bit?
That's exactly right. And I think, one of the things they're looking about immigration is many of the people who've come to this country will still be entering the labor market over the next 6 months to 12 months. So we're going to have some cushion on that as we move forward, depending on what happens with immigration policy and deportations as well. But I think it is important to understand that, once the Fed starts cutting its descent in rates, it has sort of advertised that it would like it to be much slower than the ascent. A lot of that depends on how much nonlinearity. You hear the Fed talking about that word all the time. They've always been worried about once the unemployment rate goes up, it tends to go up rapidly. That has so far not been the case, although we did breach the Somme rule. Rules were meant to be broken, as Claudia Somme herself has pointed out, and I agree with her on that. But there is just a question about how far do you want to go on that thin ice, and that's really going to be up to the Fed. But if you've really defeated inflation, normalizing in a reasonable way seems like the thing to do.
Diane, there's a lot of fear-mongering out there about this payrolls revision, and it's interesting. Bloomberg's Cameron Price has noted that in 3 decades of Bloomberg data, there has never been a cumulative one-year downward revision of 500,000 jobs or more without a recession. What do these revisions really say to you at the end of the day?
What the revisions tell us is that we actually had much more productivity growth than we acknowledged in the economy. That is actually another reason for the Fed to feel more confident, because it looks like that productivity growth has carried into 2024, and that's helping to dampen inflation as well. And much like the soft landing in the mid-90s, which was very different from this, but productivity growth and intense competition from abroad were helping to keep and doing the heavy lifting for the Fed on rate hikes. I think they need to get back into that view right now.
All right, Diane, always great to speak with you. Really appreciate your time as we count down, of course, to those revisions coming at 10 a.m. That, of course, is Diane Swong. She is chief economist over at KPMG. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
All right, it's time now for Social Climbers, the companies making waves this morning. And first up, the AI software developer Big Bear AI getting a boost after news it was part of a team that was awarded a 10-year contract with the FAA worth up to $2.4 billion. Next up, the Japanese tobacco company that makes Winston and Camel cigarettes announcing today that it will buy the Miami-based discount cigarette maker Vector Group for about $2.4 billion to expand its position in the U.S. market. And finally, an Idaho farmer is trading in his Ford F-250 for a Cybertruck. Braden Smith is using the EV to care for his family-owned 2,000-acre potato farm. The farmer and content creator has gone viral for the switch, saying that he saves a lot on fuel. He tells USA Today that when he drives his Tesla Cybertruck around the farm, he either gets a middle finger or a thumbs up. And you can follow all the latest company buzz on TREN Go on your Bloomberg terminal.
All right, let's get a check on futures right now. Just about 4 minutes to go until the cash trade starts. S&P futures and NASDAQ 100 both up about 0.2%. The small caps are leading the way, up about 2/3%. We'll talk with Stephen Whiting, Citi's Global Wealth Chief Investment Strategist and Chief Economist next, because it's not only the stock market we care about, we're also watching very closely these jobs revisions coming out at 10 o'clock. This is Bloomberg.
Make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating. And then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
All right, just about 20 seconds to go until the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. Right now, we're seeing a little bit of a gain in futures on the S&P and the NASDAQ 100, about 0.2%. The small caps on the Russell 2000, those futures are gaining a little bit more as we hear the bells ring. Down at the New York Stock Exchange, you've got, I believe, a women's soccer team. I'm not sure which one, but there is a women's soccer team, Chelsea. In fact, Chelsea's women ringing the bell at the New York Stock Exchange. I have no idea why. Take a look over at the NASDAQ, and you've got a black nonprofit ringing the starting bell, the opening bell at the NASDAQ. So with that, let's take a look at where the cash trade is going, where the indexes are moving. In the first seconds of the trade, for that, we get over to Katie Greifeld. Katie?
All right, 25 seconds into the U.S. trading day. We have a little bit of a rally on our hands, but I will emphasize a little bit. Of course, after those slight losses that we saw at the close yesterday, slight gains at the open right now. The S&P 500, the NASDAQ 100 up about 0.2%. Small caps leading for right at this moment. The Russell 2000 up about 0.5%. Of course, we are laser focused on earnings, so let's get to Target. Jumping after ending a string of sales declines and raising its full-year adjusted earnings guidance. TJX also beat. You can see that reflected in the shares. And then at the bottom there you have Macy's lowering its sales forecast, missing estimates citing increased discounting by competitors. Shares currently off almost 11%, Shanali.
Also, Katie, keeping a left eye here on the housing market. Toll Brothers up more than 2.2% as the market opens. The home builder released results after the bell yesterday, said it seems solid demand for luxury homes after that drop you've seen in mortgage rates, Matt.
All right, we're also watching Ford, the automaker, scrapping its plans for a fully electric three-row SUV in a move that may cost nearly $2 billion. But that cut in spending is helping the shares. So it looks like investors are embracing that. Ford canceling some plans as well in terms of, or pushing some back in terms of making trucks. Let's get all the details right now with the man who broke the story. Keith Naughton joins us out of Detroit. So Keith, what do we know about this kind of revamp of Ford's EV strategy, which lowers the cost or percent of CapEx they're actually spending?
Yeah, this is the biggest recalibration of their EV strategy yet, Matt. They are lowering spending on EVs. They canceled this three-row electric SUV, though they may bring it as an extended range electric vehicle, which is the combination of a small gas engine powering the battery. They're adding a commercial van, electric commercial van, and a medium-sized electric pickup truck. All of this is aimed at trying to find the elusive profitability in electric vehicles. They are predicting this year they'll lose as much as $5.5 billion on electric vehicles.
You know, it's pretty fascinating. Matt earlier today was pointing out, along with Dan Curtis, our charts producer, about the margins that Ford has relative to GM and Tesla. Is the cut they're making enough, frankly, when you think about the catch-up that they are going to have to play now to reverse that strategy?
They do have a lot of ground to make up, and they won't say when their EV unit, which they call Model E, will be profitable. But I talked to Ford CEO Jim Farley, and he said the new mantra is that any new electric vehicle must be profitable within its first year on the market. If they can't do that, it won't be approved. That's why they canceled this electric three-row SUV. They couldn't find the profitability. The bigger the electric vehicle, the bigger the battery, which is the most costly component of an electric vehicle. And that's really one of the key things that killed this electric SUV.
So for me, Keith, the bummer is that they're pushing back this new electric truck, fully new design that they're going to build in Tennessee now to 2027. The good news for Ford workers is the three-row electric SUV they were going to build, I believe, in a Canadian plant. They're now going to build their ICE, more of their profitable ICE trucks there. How much of the, you know, we talk about the $5.5 billion they'll lose on EVs this year, the $4.5 billion they lost on EVs last year. How much of that do they make up with the big margin trucks, gas trucks?
Yeah, I mean, that is what finances the company. The big trucks, which really a lot of that falls, as you know, Matt, in their commercial division, which is called Ford Pro, which has become their most profitable unit. But they're making a lot of money on those. They're making money on hybrids too. So that helps fund the EV plan. But clearly they don't want to spend as much on EVs anymore because it's a hard business to make a buck in. So that's why they're lowering CapEx on EVs to 30% of CapEx instead of 40%.
All right, Ford shares popping a little bit on that news, but of course still down double digits year to date. Bloomberg's Keith Naughton, really appreciate your reporting this morning. And let's broaden out the conversation now with Stephen Whiting. He is Citi's Global Wealth Chief Investment Strategist and Chief Economist. And of course, we are days away from hearing Jerome Powell speak in the mountains of Jackson Hole. I'm taking a look at the title of your most recent note, Fed easing. Look beyond the obvious. When you look ahead to Jerome Powell at Jackson Hole, what beyond the obvious will they, won't they, of September are you looking to hear about their cutting cycle?
Well, look, they're going to be examining the effectiveness and transmission of monetary policy. There's really no more important question for investors. I don't think it's the words of the chairman. I think everyone has to understand that in the United States, monetary policy goes from restrictive to accommodative. It's never meant to be just static. We have these moments a year at which the funds rate has been at its peak, is historically on the long side. But it's really, again, what has moved in markets, what hasn't. this is the worst kept secret in the world that they would back off from 5.5%. You could take a look at the yield curve has been inverted for a record long 24 months and counting. And yet suddenly you can see in July, August, a massive, massive move in the yen, for example. The foreign exchange market just suddenly caught up with the idea that there was going to be monetary policy convergence. So we should be looking for other things. Let me just give you one. The housing market in the United States, home resales are down about 30% from where we were before COVID, right? So there can actually be a significant impact. There has been a transmission of monetary policy. Right? There's a really bad housing market.
But it's going to take a long time, right? I mean, if they cut rates, it's going to make it easier for home buyers to get back into that market, obviously with a lower mortgage, but it's going to take time, right? These retailers that we're worried about, even the ones who do well, like Target, are saying that the consumers are much more discerning. It's going to take time for these lower rates to get to their wallets so they can spend more money, going to Disney parks.
Look, I'm sorry there hasn't been any synchronized collapse in the economy where we can have a wild rebound and everything all at once. That's actually good news. What we've done is we've hidden impacts of recession beneath the surface in an asynchronous economy. Why? Look, the pandemic had a record large decline in services employment. This is not even a cyclical part. It's the biggest part of employment, but it's not something that usually declines in recessions. When you have multi-million recoveries during the exact time where you're feeling the impact of a housing downturn, you kind of hit it all. And we are in a position now where we're probably not going to get a collapse in aggregate unemployment. We are getting a real slowdown. That's what some of the data will tell us at 10 o'clock. It might be a crawl. But lots of things don't have to happen again. There won't be a new trade downturn. There won't be a new manufacturing and housing downturn. Now, there are some policy concerns, but let's say that's not really going to come from the business cycle.
Let's just double down on the consumers. The housing market is a great example about where you're seeing that pain. You're not seeing it in the big retailers, partially because of that trade down issue. When does the stimulus, when do the excess savings, when do the cash on the sidelines stop mattering because the consumers are feeling too much of a pinch? And you start to see that maybe in Target.
I don't think that the growth rate of retail spending is going to suddenly go from 4 to 10 again, right? Nominal spending is going to stay here. We're probably going to muddle along, and the business sector has prepared for a downturn that hasn't happened. Right? So that's why last year we had a decline in imports of 13%. Particularly ahead of the U.S. election, I think we're going to pull in all the imports that we possibly can. Manufacturing production was restrained all through this. Take a look at the ISM readings. We're concerned about a recession, and there simply hasn't been one. Well, we'll probably marginally help consumers and will certainly help housing turnover when we've had such incredibly low levels. So housing-related durables will pick up marginally. It's really the finance, the economics of mortgages and housing that's going to improve on a lower base rate.
And I do like the idea of the, it sounds like you're describing basically a rolling recession.
Exactly.
Yeah, and I mean, I don't envy the Fed for having to make policy around that because it sounds difficult. But like you said, worst kept secret in the world, that 5.5% probably isn't appropriate, probably is going to come down. What's the neutral rate? Just to throw you a softball.
Well, that's a softball question. Yeah, so look, I think it's going to depend immigration. We've seen remarkable growth in the labor force from the post-pandemic recovery in immigration. Some of that is unsustainably strong. What is immigration policy? For high-skilled and low-skilled workers, what's the speed limit? It's going to be a little bit difficult to tell. The inflation rate has come down very benignly because a big part of this was really the upheaval of the pandemic, not just the stimulus, right? So I think that, we can probably achieve 2 to 2.5% PC inflation. We'll call it 2.5% CPI here. At interest rates, nominal policy rates around 3.5%.
Stephen Whiting, sticking with us from Citigroup. But we want to bring you some breaking news before we head to break as well. We're taking a look here at Franklin Resources, really dropping here on the day. They said that their Western Asset Management division is having Ken Leach taking immediate leave of absence here to focus on a Securities and Exchange Commission probe. The company said it launched an internal investigation into certain past trade allocations involving Treasury derivatives in select Western asset management accounts. We'll keep an eye on it for you. Stick with us. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday, right here on Bloomberg. Context changes everything.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks. Right now, we're seeing some slight gains after the slight drops we had yesterday. But basically, a resumption, I guess. Is resumption a word?
Yeah, sure.
Yeah, of the March higher that we've seen for 8 of the last 9 sessions. S&P 500 up 0.25%. Russell 2000, those small caps back up almost 0.6%.
Pour one out for those small caps. We're going to get also now those retail results as well, because this is really the story of the day. Macy's slumping after cutting its sales forecast, while Target is reporting strong second quarter sales thanks to price cuts that brought in more price-conscious shoppers. You can see the divergence, with Target just soaring more than 14%. Macy's
and it's ex-dividend.
And it's ex-dividend. And at Macy's down more than 12%. We're going to talk more about Target ex-dividend with Jennifer Bartashis of Bloomberg Intelligence. intelligence, and we're thinking through just what exactly is helping Target, because you saw the price trade down of a lot of consumers that help Walmart, for example. Target also talking about their loyalty programs. At the end of the day, why are they able to weather this complicated environment for the consumer?
Well, with regards to Target, one of their things is that they're continually focused on what it is that customers need. And so the price cuts that we've talked about have definitely helped because it helps resonate the idea of value with customers. But importantly, they're also in the process of refreshing and replenishing their merchandise and making it compelling at a variety of price points, which is bringing more people back to the categories which Target is most known for. So things like apparel and decor and beauty. So those are things that we're very encouraged by.
Jennifer, also really eager to get your thoughts on another big retail story out today, and that is that Walmart basically selling its $3.6 billion stake in JD.com. Of course, JD.com taking a bit of a bath today on the heels of that news. I mean, what's the logic there for Walmart, that basically they can go it alone in China?
Yeah, I mean, Walmart has had that partnership with JD.com for a long time. And what we're seeing across the consumer space, not just with Walmart, but with others, is a much more tactical approach to the Chinese market. And in the course of the partnership, Walmart has learned a lot from JD.com, particularly with regards to delivery to homes in China. And so I think this is just a reflection of Walmart becoming much more tactical, having acquired a lot of knowledge and understanding of how to run their business themselves, and finding a way to do it the Walmart way.
Jen, thanks so much for joining us. Jennifer Bartashis there of Bloomberg Intelligence, talking to us about the retailers on which we're so focused today, really because of the earnings. Let's talk about your broader stock portfolio, though, with Steve Whiting. He is Citi's Global Wealth Chief Investment Strategist as well as Chief Economist. You just had your economist hat on for the last block. Let's put your strategist hat on. How do you invest in a situation where, we've come hopefully to the end of this rolling recession, prices have come down, now the Fed's ready to cut? How do you set up your portfolio?
Well, look, we had a 25% drop in U.S. semiconductor shares in early August. That is an opportunity to buy. Closed pretty quickly. We raised our allocation to large caps. In that particular week. We still think, again, that the industry is going to be benefiting from AI spending trends, as well as subsidies, again, particularly the equipment makers for the semiconductor industry. Now, that's a narrow opportunity. Healthcare is cheaply priced relative to the broad market. We're really thinking, again, about broadening, and it's not so much just rotating out of a few mega cap companies. I mean, 3 American companies for a while were the entirety of all of Europe or Asia, but it's just gains in profits are occurring for more companies. We're going to be at a record high profit level this year. We think there'll be a new record high profit level next year. It doesn't mean that the stock market was easy to have a 20% gain. Again, that's the reason why we had room to add.
So this is a market that loves stories. It loves the AI story. That's why you've seen tech go up about a gazillion %. Healthcare, I've had so many people tell me that they like healthcare, that it's cheaply valued, as you say. But what's the story for healthcare? What will ultimately be the catalyst that, the broader investment industry actually takes a look here?
Well, I think if you take a look at some of the things that happened as recently as 2022, tech profits fell, tech shares fell 37% for the NASDAQ. They had a recovery. A broader piece of healthcare equipment and supplies had a downturn over the last 12 months, one that we've never seen before. These are companies that have a 9% dividend growth rate historically over the last few decades. So there's a catching up opportunity there. Probably a lot of worry about policy in the United States. But the reality is people growing older all across the world, moving past just this focus on GLP-1 drugs. The fact is it's going to help a lot of people, again, probably have surgeries that they've been putting off. That this is really a good value dislocation opportunity that's still there. A lot of areas. Again, we're not looking at this now, particularly after the last week, this long period of time. We're not looking at the equity market as deeply depressed. This is not, where we were at the beginning of August, and it certainly wasn't where we were, in early 2020.
Even though you see opportunities in some areas that have sold off, they reflect real worries about the economy, as we've been talking about. Your view on the bifurcated economy, what sectors do you avoid at this juncture? What kinds of stocks do you just not touch?
Well, just not touch for us. I mean, I think that it's really hard to find something that we really hate. I would just say to be really selective among small and mid-cap companies. We want to be careful that this is not Russell 2000, that this isn't been buying submerging companies that were once large caps with a lot of debt. It's buying true growth companies without a lot of leverage. So you can do this by focusing on the growth indices within profitable companies, the S&P indices for small caps.
So that rotation that we saw last month, I mean, if you look at the Russell 2000 last month, it's just stunning, the climb and then the drop, right?
Look, I think that there's, a good deal of false hope in some of these things. This is not a new economic recovery cycle. We are not about to have companies that were on the verge of bankruptcy survive and then their equities double 100%. That's the typical pattern, again, for highly leveraged companies. I mean, one of the things that we said it's not obvious about an easing cycle now is that a lot of leveraged companies are in a good place. Their credit spreads are tight. They don't have a lot of debt to refinance, particularly in 2025. Easing has a marginal benefit for them. But if we take a look at the divergence between growth companies that aren't worth $3 trillion and the rest, there's an unusually large valuation divergence, and many of these companies are going to be a part of the future. The economy is becoming...
So it's value growth, basically.
Yes. Growth at a reasonable price can be found outside of mega cap. Mega cap, I think we can look at them one by one. Our fear for them has been, and again, we've closed and underweight, our fear has been that many of these companies will compete with each other in ways that they haven't before. You could just take a look at the Mag 7. Their business models had completely different areas of demand. I'm not sure that's the way it'll be in the future.
At the top of the hour, in just about 8 minutes from now, we're going to get those payrolls revisions that we've been talking about. Could really change the story a little bit on the day, certainly the week. At the same time, something we've been talking about is positioning in bond markets, just how far traders have gone here, amassing historic levels of risk. Have they gone way too far? Can we see some real pain out there?
Look, I believe that the longer-term Treasury yield belongs in the neighborhood of 4%. And yet, if you take a look across the pond in Europe, you can see, similar credits compared to, U.S. sovereign bonds, trading at unusually steeper yield discounts to the United States. The yield opportunity in Europe is 3. The yield opportunity here is 4 for government bonds. And so, okay, I don't think that we've gone to the point where it's terribly troubling, but the bond market did its job here in early August. We had, a solid rally that offset declines in the S&P 500. We got to a richer level, and particularly for the volatile long end of the bond market, we are no longer cheap. We thought we were going into this. I don't think that's the case anymore. Are we really going to get crushed? If you take a look at mortgage rates, we're at twice the spread in mortgage rates over U.S. Treasuries that we've seen historically. We had 8 consecutive quarters of tightening lending standards by banks. If you take a look at structured securities, you're dealing with yields that are so substantially above, for investment grade, sometimes government guaranteed securities, above Treasuries.
All right, Stephen, got to leave it there. Great to spend a nice chunk of time with you this morning. Our thanks, of course, to Citi's Stephen Whiting. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is Bloomberg Open Interest. Let's take a look at markets right now. About 26 minutes into the trade, you can see a rally, a small one, but a rally nonetheless. The S&P 500, the NASDAQ 100 up about 0.3%. Your small caps actually leading the way today, up about 0.6%. Of course, the narrative could shift a little bit at the top of 10 when we get those payroll revision numbers. We'll bring you those figures as soon as we have them. This is Bloomberg.
Guaranteed, or even that it'll be easy, but at least there's a theory of change.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience for streaming on YouTube as well. So head over to youtube.com and search Bloomberg Podcast. That's where you will find the live video feed. Alex Steele out today. Not to worry, Jess Menton, Bloomberg News. She sits in for Alex for the next couple of hours. Going to be good stuff. Coming up, we're going to check in with Jody Schneider, Bloomberg. She's the political news director for Bloomberg TV and Radio. She's out in Chicago, so we'll get the latest from the DNC out there. Jen Bartashis, Bloomberg Intelligence. She's an analyst. She covers all the retail stuff here. Target putting up some nice numbers. Stock just ripping. Go figure that. Emily LaVille, portfolio manager, Thornburg Investment Management, discuss her outlook for markets. We get a lot coming up in the next hour. Let's kick it all off with Lisa Matei. We can't get rid of her. She's in here again for another hour.
Going strong. And we've got market drivers brought to you by IBKR. With Interactive Brokers Forecast Trader, you can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. All right, we've still got green on the screen. Traders looking through a mixed bag of retail earnings. Norma Linda's going to break that down in just a bit. Want to check in with the shares. So we have Target up about 14%, TJX up 5%, Macy's down 13%. Let's get to the markets now. NASDAQ up 0.4%, 74 points. The Dow up 0.1%, 70 points. The S&P 500 up 0.3%, or 18 points. We have the 2-year yield at 3.97%. That's little change. The yield on the 10-year 3.81%, and that is little changed as well. We'll look at commodities. We have spot gold lower, $2,499 an ounce. Brent crude, $77. WTI crude, $73 a barrel. That is your Bloomberg Business Flash. Over to you, Paul.
Hi, Lisa Bromwitz. Thank you so much. We appreciate that. Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We're live here on the Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, some big news, particularly for the radio geeks out there, and I count myself as one of them. Big news for our New England listeners. Bloomberg 106.1 and 1330 are moving to 92.9 FM starting September 3rd. Listen to Bloomberg Radio in and around Boston on 92.9 FM. It's your news source for Bloomberg Business News from the Financial Center of New England. Bloomberg Radio moving to 92.9 FM at noon, the day after Labor Day. 92.9 is a Beasley Broadcast Group station. Who took that company public back in the day?
Oh, here we go.
Yes, I did. BBGI. I took them company, and thank goodness they're still going strong, because most radio companies have not survived, particularly the ones that I took public way back in the day. All right, what are we doing here? We got the markets, Jess, looking a little bit higher here. I guess we're focusing a little bit on Jackson Hole in the coming days, right?
I mean, that's true. And right now, I was actually talking to Stu Kaiser over at Citigroup to see what the option market was pricing in for that move. And it's actually come down. It had been above a 1% swing in either direction for the S&P 500 in recent weeks. But now it's come down to about 0.8% swing. I think once you had a number of Fed speakers come out in recent days, about a half dozen of them signaling that they are open to rate cuts in September. Even hawks when it comes to those like Mickey Bowman. So they are expecting Powell to stay on course and to really, especially when it comes to his tone, when it's there, but they're already pricing in not as much volatility as you would expect on Jackson Hole.
All right, very good. We're looking at the S&P 500 up about 0.3%. Norma Linda joins us. She's from Bloomberg News. She covers all the markets for us. To tell us what's happening out there under the hood for these equity markets. Norma, what are you looking at?
Well, retail is really the name of the game today. We're looking at consumer discretionary being the best performing sector in the S&P 500 right now. And this is after we got a bunch of earnings from retailers. I'm taking a look at Target, and those shares are higher, jumping as much as 16%. Really important to note that it is trading ex-dividend today, so that's something to note. But this company snapped a string of sales declines that has really been crippling the company. This is really great news for investors, especially as people have been really worried about the consumer and how much they're actually willing to spend. And part of Target's biggest income maker tends to be furniture sales and apparel, and that apparently has been the pullback that a lot of consumers have been tightening their wallets for these things, and it seems like people are coming back to Target. I didn't realize they ever left.
Can you point out also Macy's? Looking at this ticker symbol is M for Macy's, down almost 14% on pace for its worst day since August of 2023, so about a year now, but that did come after it did report lower sales as shoppers were cutting back, and obviously that comes about a month after turning down that almost $7 billion buyout offer from one of its shareholders, Arkhouse, and its partner, Bridgegate Capital Management. So a little bit of a different story here when you are looking on the other side of retail.
Picking and choosing, it seems.
Right.
So, I mean, I'm looking at Target here. I mean, this is not a, small cap stock. This is $75 billion market cap stock, up 13%. I don't know what to make of the consumer. I think, you look at some of these numbers and
it's confusing.
Yes, it is.
It's definitely company by company different than
name
across
picking.
the board, of course.
Definitely.
Right. Yeah.
I mean, do you guys shop at Target?
I do.
You do?
I do.
I don't
They
shop
just
at
opened,
Target.
they just opened one near me where I live, and so
Okay.
it's more of a condensed type version. I'm used to the bigger ones in Texas, but in
Right.
Manhattan, they're much
Everything's
more
bigger
fun
in Texas.
size.
See, we were ready for that
in
one.
Manhattan here, but I like to go there. But the food options aren't quite as large at the smaller ones.
Right.
Than obviously
The food
bigger
options
ones.
at Target.
Correct. And there's a lot cheaper groceries there than at other places.
That's true.
I kind of pick and choose, though, with the groceries where I buy certain things.
So a name picker as well.
Right.
Walmart.
Yes, I'm watching Walmart, another retailer. We're seeing shares up about 1.2%. Now, while this sounds like a small percentage move, it is the highest level on record. That's an intraday level, and it is holding that since yesterday. It also hit a high yesterday, but they did temper their sales outlook a little bit. But I'm looking at Walmart. It raised $3.6 billion by selling its stake in Chinese e-commerce firm JD.com. Now, this is really capping off an 8-year partnership that it's had with the company. And of course, we are seeing a lot of companies really weighing the presence that they have in China. And this seems to be an exit here for Walmart, as this has really been a challenging landscape for a lot of these Chinese tech giants, and they seem to be seeing diminishing returns here. So investors are cheering this on, as I think that this was a good move for Walmart here.
All right. I mean, stock 52-week high today. I mean, here's stock. Walmart, $600 billion market cap, up 42% year to date. This is a retailer. This isn't a biotech company. It's up 40%. Just amazing. How about Ford? This story, Keith Naughton from Bloomberg News had this story today. Blows me away for Ford.
I mean, so they're essentially pivoting. They're taking themselves out of the EV space. They're really trying to draw back on that space. And they also are stopping their SUV that they were planning to do. It was supposed to be an all-electric 3-row SUV. It had already been delayed, but now they're scrapping it all together. And of course, as we think about this on a broader scale and just the EV space more broadly, you're thinking about a lot of these cars being high-ticket items. People aren't actually going out and buying these EV cars the way that people thought that they would. And Ford seems to be just taking a turn and realizing we need to get out, and we need to get out now. We're seeing shares of Ford up as much as 2.4%.
That tells you all you need to know. I mean, we're going to have Steve Mann on from Bloomberg Intelligence later today. He covers the global auto industry, so we'll get his thoughts on that. I'd love to talk to Matt Miller if we can get a couple seconds of his time about this whole EV business. It just feels like we've hit a real stumbling block for EVs and the adoption of EVs. I don't know. I'm not an EV person, but
we know Matt is, though.
We do.
Matt's got an opinion, so maybe we'll get Matt on there. Norma Linda, thank you so much. We appreciate that. As always, Norma Linda, she covers the markets for us here at Bloomberg News. Let's talk a little politics here because the Democrats are out in Chicago. Yesterday, Barack Obama, he delivered a galvanizing speech at the second night of the Democratic National Convention, while also giving blistering critiques of Republican nominee. The former president painted Vice President Kamala Harris as the heir of their historic political legacy, saying America's ready for a new chapter. Let's take a listen.
We do not need 4 more years of bluster and bumbling and chaos. We all know that the sequel is usually worse. America's ready for a better story. We are ready for a President Kamala Harris.
Hey, that's pretty solid stuff. Former President Barack Obama out in Chicago giving his speech last evening. Let's head out to Chicago right now. Jody Schneider's there. She's our political news director for Bloomberg Television and Radio, and she's out there in Chicago, remote, our studio out there. Jody, I mean, just to me, and I don't follow politics that closely, boy, it seems like everything seems to be kind of breaking for the Democrats in their way. Some momentum What's the feeling in Chicago from the floor?
Yeah, I was on the floor for a little bit last night, Paul, and it's electric. There's this sort of also a feeling of relief. Only a month ago did Joe Biden exit the race, and had he been in the race still, it would have been a very different kind of convention. There wasn't a lot of enthusiasm for him, given his age and some of the other issues involving his performance in debates. And so now it is clearly a different day, a different kind of feeling. A lot of excitement. And of course, the Obamas, standard bearers of the Democratic Party, and this is their hometown. They came, here to the hometown crowd, and it was very electric. Their speech was extremely well received.
Now that we are at Wednesday, so the second to the last day of the convention, what should we expect today? Because I know we're going to hear from Tim Walz today, and then obviously Kamala Harris tomorrow.
Yeah, the big speech tonight is Tim Walz, and he has only been somebody that people even knew his name for about a week and a half since Kamala Harris chose him as her vice presidential running mate. He's the governor of Minnesota. I'm from Minnesota, and I didn't know a lot about him until a week and a half ago. So he is somebody who, obviously has a really good story to tell. He was a football coach. He was a teacher. He went right from that to Congress and served in Congress more as a backbencher, but his story will be important tonight. Leading up to him will be Bill Clinton, still a very popular figure in the Democratic Party. We'll also hear from Nancy Pelosi and Pete Buttigieg tonight.
So, all right, we got a big prime time. And it comes out so late. I mean, these speeches are so late.
I was going to say this.
I am well in bed, so I don't know who's in charge of that. Who is in charge of that? They're not.
I have to catch up on everything.
They're not media
people. From both
people.
Conventions the next morning.
Hey, Jody, how about from the Republican side? I mean,
I'll watch for you.
Yeah, it feels like they're a little bit, the Republicans, on their heels here. Or is that just kind of the momentum of a Democratic convention? What are you seeing from the Republican side?
Yeah, that does happen a lot during the other party's convention, right? But usually the person whose convention it's not kind of lays low and figures, all right, we'll let them have their convention and then we'll go back to the trail. But Donald Trump's hitting the trail himself, going to a bunch of swing states, and he will continue to do that. He's hitting North Carolina again today with his Vice President, J.D. Vance. It's the third time Donald Trump will have been in North Carolina in a few weeks. It's a must-win state for him. So that makes some sense. But he's out there kind of every day a different theme. Today's theme is national security, but it's hard to match that enthusiasm and that excitement and that newness of the Harris Walz ticket.
Right.
So, but he's trying. He's still out there this week.
Jody, just 30 seconds left. Criticism of Kamala Harris right now is that she's done no press, no media. When do you expect her to sit down and start interacting with the media?
Yeah, I think she's going to need to do some kind of press conference or some interviews after the convention, because that is something you hear a lot, that why hasn't she done that? She shouldn't, seem to be hiding. So I would expect the convention is very scripted and she'll have her big moment with her speech Thursday night. Yep. But I think that the thinking is she needs to do some soon.
Very good. All right, Jody Schneider, thank you so much. The pride of Minnesota, Jody Schneider, political news director for Bloomberg Television and Radio. She's out there in Chicago at the Democratic National Convention. I tell you, one of the stocks today, again, really jumps out at you is Target. Our friends at Target put up a solid quarter here, and the market loves it. Stock's up 13%, which, again, for a retailer of that size, to have that kind of a move in a stock really kind of jumps out at you.
Another one I'd point out, too, TJX. Up 5%, trading at an all-time high,
that?
Also on the back of strong results.
Let's check in with an expert on this stuff. Jen Bartashis, she's Bloomberg Intelligence Senior Analyst. She covers all that retail stuff. I'm not really sure what's going on there, but she's the expert. So, Jen, talk to us about Target. What are they doing right there?
Good morning. Thanks for having me. And with Target, what we're really seeing is that they sort of reaffirmed their strategy around creating newness, reducing prices, and enhancing the value perception they have with customers. And this second quarter results, we really see that is starting to resonate, especially because they're seeing traffic going back into stores as well as online. So really, positive early signs from Target that this momentum might be able to continue.
What about when it comes to consumer packaged good companies? Because you and I have talked in the past, and we know that Richmond Fed President Tom Barkin watches price to mix very closely, and that's a lot of the data that you crunch over at Bloomberg Intelligence as far as what that means for inflation and also the direction potentially for Fed policy. What are you seeing on there as we begin to get more consumer packaged good companies reporting as well?
Well, what we're seeing is obviously there's political, pressure with a lot of rhetoric going on right now about the need to lower prices. We're seeing retailers like Walmart, like Target, like Kroger, like Albertsons pushing back on packaged food companies who are, in some instances still looking to push through some selective price increases. So there is that tension that's happening kind of behind the scenes. But overall, we are seeing prices on the shelf starting to come down, and that spells relief for consumers. It's just a matter of how long it takes for them to actually recognize it and appreciate it and reward it with higher volumes that they're buying.
What's Target saying about the consumer? What are the other retailers that you talk to, Jen, you follow? What are they saying about the consumer today? Because I think as investors, we kind of feel like we're getting mixed messages about the consumer.
Yeah, I think when you're talking about the staple space, which is, where these companies that I follow fall, it's that the consumer is not getting worse. They're not necessarily getting better, but they're sort of holding steady. And part of that is that we've had some consumers who kind of trade down into those middle tier stores or even to some of the discount stores in order to save a little bit of money. So the companies in this space are pretty well positioned because they do well no matter what the economic circumstances are. And I think that's showing through with the results. But they're saying, consumers are spending, but it's still very thoughtfully. And so the things that will attract them to spending is your merchandise mix, your newness, your convenience, the quality, things that will then tempt them into spending the dollars that they're managing very carefully.
We only have about a minute left here, but you've talked a lot about how you're expecting more consumer packaged good companies to roll out promotions in the second half of the year, like buy one, get one free, buy one, get one 50% off. What are you seeing so far with that as far as what companies are saying on these earnings calls?
Yeah, promotions have definitely accelerated, and we are back at sort of the levels that we were at before the pandemic. What's interesting is most of these companies say that they're able to be more precise so that it's not just a blanket offer like you used to see on the front of an insert or a mailer, but they're sort of targeting promotions to customers based on what they buy. So they're able to preserve a little bit of profitability and still offer higher discounts. And so I think that's a pattern that we're expecting to continue through the second half and probably into 2025 as well.
Hey, Jen, thanks so much for joining us. As always, really appreciate getting a few minutes of your time. Jen Bartashis, she's a senior analyst at Bloomberg Intelligence, covering all the retail space, one of the real leaders on Wall Street, providing research analysis on the retail space. Talking about Target today, stock's up 13%. TJ Maxx also having a good quarter. That stock is up, suggesting that the consumer's hanging in there. So that is good to see. Seeing a little bit of red and green on the screen here. S&P is up about 10 points. NASDAQ up about 0.3%. So we got a lot coming up. Emily Lavelle, portfolio manager, Thornburg Investment Management, coming up.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, stocks, we've got a mix of red and green on the screen, and this is we await headlines on the annual revision of non-farm payrolls data for more clues about the health of the economy. The data from the Bureau of Labor Statistics, it's been delayed. It was supposed to come out at 10 a.m. Wall Street time, but signs of weakness in that adjustment. It could point to the need for aggressive Fed rate cuts. You had Goldman Sachs, Wells Fargo economists expected the preliminary revisions to show payrolls growth in the year through March was at least 600,000 weaker than currently estimated, about 50,000 a month. JP Morgan Chase forecasters saw a decline of about 360,000. Stay tuned for that. More data out later this afternoon. We also get minutes from the Fed's last meeting. So we have the NASDAQ up about 0.4%, 80 points. The Dow, little change, up about 2 points. And the S&P 500 up about 0.2%, or 16 points. We have the 2-year yield at 3.96%, and that's down 1 basis point. The yield on the 10-year 3.80%, and that is little change. Looking at currencies, the dollar stronger, Japanese yen weaker, down about 0.4%, 145.89 against the dollar. We have the euro weaker, British pound stronger. We have Bitcoin up about 0.5% at 59,000. That is your Bloomberg Business Flash. Paul and Jess.
Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We're live here in the Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Jess, you know, someplace I really want to go that is way off the beaten trail, and I probably couldn't even get anybody to go with me, Santa Fe, New Mexico.
Oh, I've never gone to Santa Fe.
Looks very, very cool. And there's some cool people from there.
A little Bloomberg intelligence trip.
I think so.
Over.
But now I think I might have a reason. Our next guest is from Santa Fe, so we can go out and visit our good friends at Thornburg Investment Management. Emily Lavelle, she's a portfolio manager. How she ever got to Santa Fe, New Mexico, I'm sure there's a story there. Emily, thanks so much for joining us from Santa Fe, New Mexico. What are you making of this market here, Emily? I mean, we started 2 weeks ago, Monday, a crazy, crazy day, a big sell-off in the market, maybe some panic in the market, I guess. But boy, we seem to have found our sea legs since then. What do you make of this market?
It's been really interesting, hasn't it? I mean, yeah, two and a half weeks ago, it felt like the bottom was falling out, and you know, we've really seen a recovery in the strength of the market in the last couple of weeks, a return of that momentum factor, you know, which I think is a really important indicator of, you know, where the market goes from here, and some pretty decent data as well. I mean, I remember part of that weakness was some of the data that came out, and then since then we've had, you know, pretty decent data on retail figures, some better data on jobs numbers, and I think now everyone's looking ahead to the Fed, and then obviously what's going to happen in September, and I think it's just really going to be data dependent from here.
And we were just talking about, Emily, how some of that BLS data on the annual revisions through the year ended through March were delayed. But if you look at this, U.S. employment rose about 1.3% in the year through March of this year, BLS is saying as well. And then also, I was looking at Goldman Sachs was talking about how the release so far points to a downward revision in the realm of about 70,000 jobs per month. So waiting for that full release here. But wanted to pick your brain because this is obviously backward-looking type data. Also, Goldman Sachs, their economics desk, was pointing out how when it comes to, because they're looking at wages and claims data, so it won't include undocumented workers. So there's about potentially up to 1 million of them that wouldn't be included in this data. So when there's a lot of jitters about, say, the July slowdown in payrolls, which is obviously just 1 month of data, we haven't seen a trend yet. And looking at how the market's reacting, the S&P 500 still higher. It seems like options market wasn't really pricing in a big move here. So what's your kind of view here when you're looking at obviously more backward-looking data, and does this really shape anything, and how much does it really tell us about the labor market?
Well, I think, you know, from memory, 70,000, a monthly revision of about 70,000 jobs was a little bit on the lower end of, or sorry, on the higher end of what the market was expecting. I had in my mind something between 30 and 50,000, you know, based on some of the estimates from the sell side. So a little bit weaker, I think, and, you know, probably one of the larger revisions we've had in the last decade. So, you know, we definitely think that we're in the later stages of an economic slowdown. I think this data probably confirms that. You know, we're seeing employment growth slow in the U.S. I think that's normal considering the big moves in rates that we've had over the last 2.5 years. I think it's unrealistic that you go from 0% to 5.5% rates without any changes in the labor market and, you know, sort of aggregate demand figures. So I think it's reasonable. I think we're in the later stages of a cycle. We see that in some of the mixed consumer data that's coming out as well. I don't know that it's going to change anything about, how the Fed acts. I think they have to thread this needle between, being proactive and data dependent, but not seeming to panic. And so I think it probably, we still get 25 basis points of cuts in September. Probably we get a couple more through the end of the year. But I don't know that this data really changes dramatically what Powell is going to say on Friday.
Emily, you are the co-portfolio manager of the Thornburg International Growth Fund. Where do you guys, internationally, where do you see opportunities outside of Santa Fe?
Well, it's so interesting you say that. We're almost international here. We used to be part of Mexico, but one of the things that that we've noticed in this sell-off is, while the S&P is just a touch off of all-time highs, international markets haven't recovered quite as significantly from the sell-off. So the Nikkei, still off about 10% from its all-time highs. Some of the markets in Europe as well. And as growth investors, we're really focused on finding the opportunities that are going to be able to grow earnings power throughout an economic cycle. So we actually see some pretty interesting opportunities that have been provided to us by the recent volatility. So we still like the AI theme. We get a ton of exposure in high quality businesses that are key to this infrastructure build out outside of the United States. So companies like ASML in the Netherlands, like Disco in Japan. There are a number of these semi-cap, TSMC as well in Taiwan. These semiconductor and semi-cap equipment companies are core to this build out. Another area that we really like and where we see some strong long-term winners in international markets is in the healthcare space. So we have Novo Nordisk, we have AstraZeneca. These are really best-in-class, high-quality businesses that are now trading, well off their all-time highs, particularly in the tech space. And then the other thing that's kind of interesting about what we've seen in the last few weeks with, the recent moves and the pricing into the Fed cut is a weakening of the U.S. dollar. And what we like to tell our clients, especially as international investors, as, you really might want to think about diversification outside of the U.S. The Mag 7 has dominated, obviously, in everybody's minds, and Mag 7's up 38-40% year to date. But we've got companies outside of the US that give investors diversification that are up even more than the Mag 7 this year. We affectionately dub two companies in Latin America, New and Meli, the Mag 2 of Latin America, and they're up a combined 51% in US dollar terms year to date.
And you were mentioning the S&P 500 being a whisker away from that all-time high. If you look right now, Paul, the S&P is about 0.9 away from that July 16th closing high after falling as much as 8.5% after that drawdown that we saw earlier this month. So Emily, I'm curious because I know you were mentioning how you were managing this growth fund. What are you advising clients to buy? What do you basically suggesting them to sell after we saw such a big drawdown, but then a huge bounce back?
Yeah, it's been a wild ride. As we were commenting at the beginning of the show, we really focus on building a diversified portfolio. So we talk about, diversifying those sources of growth. And definitely what we're looking for right now are what are the businesses that can grow earnings power regardless of what's happening with GDP. So we talked a little bit about AI and that CapEx build out. We think that's going to be pretty resilient and insulated, not totally immune, but pretty insulated from, what's going on in the broader macroeconomy. We also think healthcare and some specific areas of healthcare. So, we're big holders of Novo Nordisk. We think GLP-1s have a tremendous runway for growth. There are almost 1 billion people suffering from obesity today. And when you look at the number of people that have been treated by GLP-1s for obesity at this point, we're in the tens of millions. So, that's going to grow. That demand is going to grow regardless of GDP. Another area that we really like within healthcare is ocular health, cataract surgery, a company, Alcon, that just reported yesterday. They're the leaders in cataract surgery and contact lenses globally. And again, demand for cataract surgery, that just grows with an aging population. So in as much as investors can get diversification of growth and earnings power that is dependent not on GDP, we think that that is sort of a wise area to be focusing on at all times, but particularly now when, there's a lot of mixed messages. I mean, we were talking earlier about the consumer in the United States. You've had pretty mixed data from companies in the consumer space. In general, I think pointing to a consumer trading down, looking for value for money. And so, you know, we're really being cautious in the consumer space and focusing on those areas of growth where we find businesses that can continue to grow their earnings power through a cycle.
Hey, Emily, thanks so much for joining us. Really appreciate getting your thoughts this morning. Emily Lavelle, she's a portfolio manager, Thornburg Investment Management, joining us from Santa Fe, New Mexico. I'm putting that on the bucket list. I'm going there.
Let's do it.
It looks cool. While you were talking to Emily, I was Googling all through about Santa Fe, New Mexico, not paying attention at all. It looks very, very cool out there in the desert. A lot of fun. It's got a big arts community and so on. But
yeah, maybe we wait till it gets a little bit cooler. And then
maybe,
we go in the
yes,
fall.
because it is in the middle of the desert. But it seems like a pretty cool place to be. And I don't know any money management firms out there other than Thornburg Investment Management. I know there probably are, but that's reason enough itself to go check it out.
You know, quick update, because we were talking about that preliminary U.S. payrolls data. So our friend Molly Smith over on the economics desk, her group saying that the Bureau of Labor Statistics has yet to release most of the headline numbers there for that preliminary revision. So it's supposed to be scheduled at 10 a.m. in Washington time. We got a couple of the state data, but still waiting on that headline data. So we'll keep you posted once we get that.
Do I care, though?
No, because the option market doesn't. I'll tell you right now, they're pricing in a 5% move in either direction.
I've been doing this Wall Street thing for 40 years, and I've never once heard of this data point. And so I can't imagine.
It's backward looking, so traders are over
It's that important, so we'll see. But we'll stay on top of it, because that's Bloomberg News. That's what we do. If there's anything to do with markets, we take care of it. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Jess, Lisa. The Democratic National Convention heads into day 3 with Minnesota Governor Tim Walz preparing to accept the nomination as vice president. More from Bloomberg's Kevin Whitelaw.
Democrats so far have been very, very happy with the reception that Tim Walz has gotten and his sort of plain-spoken but powerful ways of sort of setting the political stakes and taking on Donald Trump. So I think it's an important moment where they can where Democrats will be introducing him to an even wider audience.
Bloomberg's Kevin Whitelaw. Walz is scheduled to speak around 10:45 p.m. Wall Street time, and Bloomberg will carry it live. Last night, the convention concluded with a speech by former President Barack Obama. He praised President Biden and Vice President Kamala Harris while criticizing former President Donald Trump.
If we work like we've never worked before, if we hold firm to our convictions, we will elect Kamala Harris as the next president of the United States.
Former First Lady Michelle Obama also spoke. Donald Trump, meanwhile, is out on the campaign trail as part of his week-long swing state tour. He was in Howell, Michigan.
This is a very dangerous time that we're in. It's dangerous in terms of crime and all, but it's very dangerous in terms of a possible World War III.
Today, Italian divers resumed search and rescue efforts for a third day around a sunken yacht off Sicily, where British tech entrepreneur Mike Lynch and several others were feared to have died earlier this week. Robots have been deployed in the search. 2 bodies have reportedly been found by the wreck. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Yes, the revisions are in. U.S. payroll seen as revised down 818,000. In the 818,000 in the preliminary revision. Now, the Bureau of Labor Statistics also says U.S. unemployment 1.3% in the year through March 2024. I want to get to the reaction, though, on Wall Street. Could we see the NASDAQ tick up a little bit? Now up about 0.6%, 123 points. The S&P 500 ticking up about 0.5%, 29 points. The Dow up about 0.2%, or 98 points. Traders, they're also gearing up for the Fed minutes. Later this afternoon, we also have a key speech from Fed Chair Jay Powell at Jackson Hole this Friday for kind of any insights into interest rates. Meanwhile, you have Fed Governor Michelle Bowman says she would support rate cuts if the growth in prices slows further. I want to get to the bond market. The 2-year yield, 3.97%. That's down 1 basis point. The yield on the 10-year, 3.82%, and that is up 1 basis point. We have spot gold lower, $2,495 an ounce. Brent crude, $78 a barrel. WTI crude, $74 a barrel. And Paul and Jess, Starbucks gearing up to release one of its biggest strategies to get customers back in the store. Paul loves this. The pumpkin spice latte comes out tomorrow.
Dude, it's August.
Yes,
I want to know if they have pumpkin spice,
soon.
those cake pops.
Those are the good ones, too.
Yes.
They also have apple beverages that are coming out, so stay tuned for that. But they have a lot to do. I mean, they have this new CEO. They're trying to get things started. They got 2 quarters of same-store sales decline, so they really need this latte to be a big win for them. That is your Bloomberg Business Flash.
I am seeing Halloween stuff in the store, so...
Yes, I saw Christmas.
Did you? Oh,
yes. Costco has Christmas stuff already. It's killing me.
Exactly. Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Alex Steele. Today, I'm Paul Sweeney. We're broadcasting live from the Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. All right, let me just get this out of this way.
Right, we have to address it.
U.S. job growth is probably far less robust, blah, blah, blah. So they revised down payrolls 818,000 in the year through March. I don't remember this ever being a thing, but let's assume I was just asleep for the last 37 years on Wall Street. What is it?
Okay, so this happens annually, and to point out, this is preliminary, so this goes from April of last year to March of this year. They do revisions, but then the final estimate doesn't come out until the beginning of next year. The reason so many people were focused on it, though, was on the back of that slowdown we saw in the July hiring numbers from BLS. But to put into perspective, because I covered this for our Taking Stock column this morning, because I was reading how so many people were writing these stories about how people should be concerned about what it could mean for job growth and the Fed direction, things like that. But I mean, since I cover markets, I was looking at what the options market was pricing in. Only about 0.5% in either direction. And really, it has to do because, to your point, Paul, I mean, this is backward-looking type data. This isn't going to tell us necessarily anything new. Also, Powell pointed out at his press conference after the June meeting that he was aware that some of the jobs data was a bit overstated. So he said this during his Q&A. And other Fed officials have talked about this as well. I think the Philly Fed has some data and some research that they've done about this. And then also Goldman Sachs and other banks had put out reporting that even though they expected a big downward revision, potentially between 600,000 and about 1 million, which this did come in between that, it doesn't include undocumented workers because it also adjusts this based on certain jobless claim type data, and a lot of those benefits are not offered to those types of workers. So it wouldn't include potentially around 1 million of those workers based on Goldman Sachs economist estimates there. So that's why when you're looking at traders and what they're watching here, kind of shaking that off, you're looking at the S&P 500 up about 0.6%, less than 1% away from that all-time high last reached on July 16th.
All right, so just to be clear, you wrote a Bloomberg News article on this. All right, so everybody who's listening and watching, can you please just go click it, because I will not. I'm not going to read that. I love your work, but I'm not going to read it.
No, but that was the whole point about why traders weren't going to care about that data. It was about why the option market wasn't pricing at a big move, because it's backward-looking, and they already knew it was going to be in the data.
All right, so before this report, the BLS initial payrolls figures indicated employers added 2.9 million total jobs in the period ended March, or an average of 242,000 per month. Now, the monthly pace is more likely to be around 174,000, assuming the change is distributed proportionally. Still a healthy rate of hiring, but a moderation from the post-pandemic peak. So we're still adding jobs, just at a little bit lower rate. And here's my favorite part. The final figures are not going to be until early next year.
Correct.
So the economists are telling you, we got it wrong, but we're going to, on our second pass, we think it's this number. but we still have a final pass to go.
Yeah, and they go through and they calculate this. So this, again, this happens every year. This is why traders on Wall Street are looking past this. And I wanted to point out because, as you know, Paul, volatility cooling pretty dramatically after we saw the VIX spike in intraday trading about 2 weeks ago above 65. You're seeing where it is now around 16. But I was looking at the appetite and how it's dramatically fallen for options contracts that bet on more losses. So this is some data I pulled in the terminal, and nearly 40 million put options had traded on UX exchanges at the start of the month. That was the most since the regional bank crisis in March of last year. But now it's nearly 17 million. So that's where around it was on July 31st after that Fed decision. So you're seeing right now options traders aren't betting on more losses, Paul.
And you wrote an article on that?
Correct.
Okay, do I read that one? I'll read that one. I'll read that one, okay. All right, I just saw literally as we were speaking, Lisa Abramowitz with her suitcase heading out with a determined look on her face, heading out to Jackson Hole, Wyoming. So she's gonna be joining Tom Keene and Michael McKee out there in Jackson Hole for a bunch of economics folks get together, including a lot of central bankers, and we'll hear from Fed Chairman Jay Powell on Friday. And Tom and Lisa and Michael McKee were reporting live there Friday morning. So the question for a lot of folks is, what are we going to hear from Fed Chairman Jay Powell? What does it mean for the markets, including the FX market? Audrey Child-Friedman joins us. She's a team leader and chief FX strategist at Bloomberg Intelligence. She's in London joining us from Zoom. She's at Bloomberg Intelligence. Audrey, I'm looking at the U.S. dollar. Talk to us about the weakness that we've seen in the U.S. dollar. What's causing it?
Well, it's been all about acknowledging the weakening economic climate that we've seen in the U.S. over the past few weeks, and really accelerating a little bit in the summer. And with that comes associated expectation for lower interest rates and a revival in the rate cuts, in the Fed rate cuts, policy expectations getting into the September meeting. And that's very much the main reason why the dollar has been trending lower over the past 5 to 6 weeks.
And as you know, the dollar-yen, when it comes to the carry trade of Indian markets, briefly earlier this month. But what can you tell us as far as the direction of the dollar as well? Because obviously, if you have the Fed approaching the end of its most aggressive hiking cycle in recent memory and then beginning to cut rates, even if it is at a more measured pace, wouldn't that bode well in the fact that you wouldn't have necessarily as strong as a dollar strength as, say, as you would have when it peaked out in September of 2022?
Well, I think on dollar-yen, the narrative, again, is bearish. I also believe that, I mean, we just talked about the U.S. side of the equation. There's also, at the same time, a near-term policy divergence between the Fed and the BOJ, where the BOJ is also normalizing rates, but to the upside. And that means that the carry conundrum that was weighing against the yen for a very long time is starting to unwind. So in absolute terms, there's still a significant yield differential at the advantage of the US dollar, but in FX, everything is relative. So the relative yield differential, current and expected, is now shifting more in favor of the yen, and that's what we're seeing. However, I think that, you know, we are unlikely to see moves to the extent that we've seen in recent weeks. That was also due to the fact that it was a very thin market environment, positioning was stretched, and we've seen, you know, quite a significant unwind of that positioning in the past few weeks. So I'd be more in the camp of expecting a continued slide in dollar-yen as opposed to a slump in dollar-yen in the weeks and months to come.
All right, Audrey, thank you so much for joining us. Audrey Child-Friedman, she's a team leader. She's a chief FX strategist at Bloomberg Intelligence. She's in our London office joining us via Zoom. And again, just looking at the Bloomberg Dollar Index, you know, looking at it over the past few weeks, we've definitely seen a weakening in this dollar versus other categories. And I'm just looking at the Bloomberg Dollar Index, and really, since I guess about, you know, towards the end of June, it's down about a little over 3% versus a basket of industrial currencies as well. So that is notable. And as Audrey was suggesting, perhaps a little bit more weakness left to go here. Looking at the markets, the S&P 500 up 0.4%. The NASDAQ up 0.5%. The Russell up about 0.7%. So a little bit more performance out of the small cappers. 10-year Treasury yield absolutely unched on the day, 3.8% for your 10-year. WTI crude oil It's up a little bit. We're just still just under $74 per barrel for WTI crude oil. We'll have more coming up. This is Bloomberg. Good morning.
company news headlines on Bloomberg Radio.
With the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Macy's says more discounts from rivals and a cautious consumer to blame for its sales miss in the latest quarter. The company also lowered its sales outlook for the rest of the year. Its Bloomingdale's and Bluemercury divisions, that actually performed better than its Macy's nameplate. We have Macy's shares down about 13%. TJX, the company behind TJ Maxx, Marshall's Home Goods, well, it had some better news. It posted another quarter of sales growth, raised its profit forecast for the year. TJX also announced it acquired a 35% stake in Dubai-based Brands for Less for $360 million, and that'll give its access to consumer markets in the Middle East. We have TJX right now up about 5%. Target finally snapped 4 straight quarters of declining sales, and the shares are soaring because of it. They're up about 12, almost 13%. We get more from Bloomberg's Kriti Gupta.
They're boosting their annual profit outlook. They're saying, look, there's improved traffic, there's improved spending as well. People call it Target. It's a little bit more expensive than your classic Walmart customers.
I have to admit, I call it Target too. Now, Kriti also mentioned Walmart, which reported a beat last week, but this week it's in the spotlight for raising about $3.6 billion by selling its stake in Chinese e-commerce firm JD.com. Now, Bloomberg's Subrat Patnik reports that the tech landscape, it's shifted in China since Walmart first bought into JD.
They made an investment around 8 years ago, and things in the Chinese e-commerce market looked very different. We had Alibaba in the lead. side. Then we had JD, and then PDD was kind of smaller. But with the advent of Temu, the entire landscape has kind of changed.
We have JD.com ADRs down about 6%, Walmart up about 0.5%. And Ford pulling back further from EVs. The company has canceled a fully electric SUV. I'm Lisa Mateo.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, looking at these markets here, we've got a little change in the S&P 500, pretty much unchanged. The Dow's off about 0.2%. The Nasdaq's up about 0.1%. The yields are also steady. 10-year Treasury yielding about 3.79%. Bitcoin, it is trading at 59,300, pretty much unchanged on the day. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Jess, and Lisa. Eyes will be on Tim Walz's acceptance speech tonight as Kamala Harris is running mate on day 3 of the Democratic National Convention. Last night, Barack Obama, along with former First Lady Michelle Obama, delivered speeches. The former president spoke about the party's presidential nominee, Vice President Kamala Harris, and took aim at former President Donald Trump.
Here's a 78-year-old billionaire who has not stopped whining about his problems since he rode down his golden escalator 9 years ago. It has been a constant stream of gripes and grievances that's actually been getting worse now that he's afraid of losing to Kamala.
Michelle Obama told the crowd to get out and vote.
This election is going to be close. In some states, just a handful, listen to me, a handful of votes in every precinct could decide the winner. So we need to vote in numbers that erase any doubt.
Former President Trump says Republicans are the party of common sense during a stop in Michigan yesterday. Bloomberg's Anne-Marie Hordern has more.
Trump will be in North Carolina with J.D. Vance today talking about national security, and then tomorrow at the border. So really this idea, are you safer abroad and at home with Biden-Harris?
Bloomberg's Anne-Marie Hordern. Divers searching the wreck of a super yacht that sank off Sicily have recovered at least 2 bodies as the search for more missing passengers continues. The yacht that carried tech tycoon Mike Lynch went down in a storm early Monday as it was moored about a half a mile offshore. Officials said they believe the yacht was struck by a waterspout. A school shooting in Bosnia leaves at least 3 people dead. An employee in a secondary school in Sanski, some 180 miles northwest of Sarajevo, shot and killed the principal, a teacher, and a secretary. He used a military weapon, an automatic rifle. Global news 24 hours a day and whenever you want it. With Bloomberg News Now, I'm Michael Barr, and this is Bloomberg. Paul, Jess, and now Charlie.
All right, Michael Barr, thank you so much. We appreciate it. Jess, we had an M&A trade in the coal business today. U.S. coal producer Arch Resources agreed to merge with Consol Energy in a $2.3 billion deal aimed at creating a North American mining heavyweight to deliver the fuel around the world. The new company will own 11 mines, producing thermal coal for power plants and metallurgical coal for making steel. While the dirtiest fossil fuel is a major driver of climate change, it is also among the commodities most crucial to the global economy. Demand for steel and the materials used to produce it is growing over the long term, while the consumption of coal for electricity generation remains strong, even as nations seek to shift to cleaner energy. So, we're trying to get to some of these cleaner sources of energy, but during the transition, there's still demand for fossil fuels.
If you look at the stock reaction to this, Arch Resources, ARCH is the ticker, up about 4%, on pace for its best day since July 1st. And you move over and look at Consol Energy, CEIX is the ticker, up about 6.1%, on pace for its best day since August of 2023, Paul.
Interesting. So executives stressed on the call with investors that the two companies have little operational overlap, which should help the tie-up win regulatory approval. Arch's planned move to merge its operations in the Powder River Basin, which is in Wyoming, with those of rival Peabody Energy Corp. Was rejected by a federal judge in 2020, but they're confident that this can happen. And of course, the first thing I do when I see an M&A trade, what bankers are getting paid here. Moelis & Company advised Consol, and Perella Weinberg Partners advised Arch. So you got two independent, kind of the smaller M&A focused shops getting this business as opposed to big, fully vertically integrated, big operational investment bank. So you should see just get paid there. But again, consolidation continues in the energy business, this time in the coal space. Arch and Consol, $2.3 billion deal. We'll have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to break through some of these earnings that we've had here. Mary Ross Gilbert, she's a Bloomberg Intelligence senior equity analyst. She's going to walk us through Macy's, TJX. What are we hearing from the retailers here? How's the consumer out there? And then really important coming up, we had Ford Motor Company out with some news today that they're really stepping back a little bit on their EV business, at least in the near term. I really want to dig into that story. We can do that with Steve Mann, Bloomberg Intelligence Global Autos analyst. He's going to join us. Jill Shaw, Bloomberg distressed debt reporter on B. Riley. That's a boutique investment bank. B. Riley's money machine ensnared in retail investors, and they're having some problems there. And the founder of B. Riley trying to buy out the brokerage firm. So we'll get the latest reporting on that. But first, let's go to Charlie Pella and get a Bloomberg Business Flash. Charlie.
Thank you very much, Paul Sweeney. Indeed, happy Wednesday. We have got stocks trading mixed with the S&P higher, holding on to a gain of just 1.5599 right now. Dow Jones Industrial Average, though, in the red. The Dow down 74, drop there of 0.2%, while the NASDAQ Composite Index higher by 7 right now, up by about less than 0.1%. Russell 2000 Index of small company shares, it is up by 0.4%. Stocks did trim gains after the annual revision of U.S. payrolls, with Wall Street now gearing up for the Fed minutes at 2 o'clock Wall Street time in the run-up to Jay Powell's speech on Friday. 10-year, 3.79%. The 2-year now 3.93%. Spot gold down $11 the ounce, 25.02, down 0.4%. West Texas Intermediate crude 73.13 for a barrel of WTI. Just under 3 hours away from those Fed minutes, they do drop at 2 o'clock Wall Street time. Diane Swank is chief economist at KPMG.
I want to see in the minutes today how seriously they talked about a July cut. We know that came up. Chairman Powell made that point at the press conference, and the question was, how serious did they really weigh a July cut?
Diane Swank of KPMG. Retailers front and center this morning. Earnings out of Target, Macy's, and TJX. Target up 12.2%. Macy's after earnings down 13%. TJX after earnings higher by 5.5%. And of course, more on those retail earnings coming up in just a moment on Bloomberg Intelligence. So again, recapping, S&P right at 5,600, even up 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pella, thank you so much. We appreciate that. Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, some big news for our New England listeners. Bloomberg 106.1 and 1330 are moving to 92.9 FM. Starting September 3rd, listen to Bloomberg Radio in and around Boston on 92.9 FM. It's your new source for business news from the financial center of New England. Bloomberg Radio moving to 92.9 FM at noon, the day after Labor Day. How about that? Let's check in on these markets here. As Charlie was just saying, kind of a mixed situation going on out there, but let's look under the hood. Norma Linda, she covers all the equity markets for Bloomberg News. She joins us here in studio. Nora, what are you looking at?
Well, the name I've been watching all morning is Ford. As we're looking at the auto space, Ford actually scrapped its electric SUV that it had planned to roll out. It had earlier said that it would have postponing its new electric pickup and reduces spending on EVs to 30%, but now it's just scrapping the all-electric 3-row SUV altogether. So this is really just marking that shift that we've been seeing with a lot of these automakers really struggling to make that pivot to EVs and really getting that consumer demand that they're looking for. And so we are seeing the CEO, Jim Farley, he's initially accelerating Ford's shift to EVs when he initially took over the job about 4 years ago, but now it looks like they're reversing course.
Also looking at Ford stock, ticker symbol's F on this. If you look at from where it had peaked out in July to as much as it had dropped, it dropped over 30% at one point. Now it's about 26% off of that high. So it's had a steep decline here when you are looking at this particular stock, especially relative to its competitors.
Right. Yeah, it's interesting. I think this is shocking. We're going to talk to Steve Mann from Bloomberg Intelligence, covers the autos, because I want to get, the big question is, really, where is demand for EVs globally? I think that's a big unknown. What else you got, Nora?
I mean, I'm looking at retailers. We can't stop talking about them. Macy's is not doing too hot this morning. Its shares are dropping for their worst day since mid-July. Shares are down as much as 14%, and this is after the company slashed its forecast, saying that competitors are increasing their discounts and consumers are turning more cautious. Now, one thing that I thought was interesting to note is that the CEO said that they didn't see any material change in traffic, but they did see a change in conversion. So essentially that means that they're seeing people still coming into the store and browsing, but they're not actually going to the front and checking out. And so that's a bit more cautious than they had seen previously. And to counter the slowdown, they're really focusing on cost cutting moving forwards, but they are opening more locations of Bloomingdale's and Bluemercury.
Yeah, if you look at that stock, Nora was mentioning intraday trading, its worst day in about a month. But if you actually have that and it holds those losses through the close, it'll be its worst loss in a year.
Oops. Yep. Still, guess up over the trailing 12 months, up 5%. It's down 23% year to date. How about Toll Brothers?
Yes, Toll Brothers. You know I love my real estate names.
Yes.
This is a luxury home builder here, and its shares are up this morning. They're seeing their biggest gain since July, up as much as 7%. Now, orders were a soft spot here as we look at Toll Brother earnings, but it did see a pretty positive read-through overall with its guidance beating expectations. When I'm looking at the stock in Wall Street, it has 12 buys, 5 holds, and 3 sells. So analysts are still pretty bullish on the stock, and this really reminds me of my story that I wrote last month just about the idea that nearly 50% of luxury home buyers are paying for things in all cash. So they're out there and they are spending, and Toll Brothers targets those types of shoppers.
Yeah. I was looking at XHB, so it's the ETF that tracks the home builders in the S&P 500. Dropped as much as almost 11% last month from that drawdown, but it's actually just off about less than 4% from that high. So it's pulling back, and it's rebounded a lot since the pullback that we saw in July.
We'll see what happens when interest rates start to move lower. We do have the mortgage, 30-year mortgage, about 6.5%. So that is of note, down from a peak of over 7%. Nora Melinda, thanks so much for joining us. Nora covers all the stocks for Bloomberg News, joining us live here in our Bloomberg Interactive Broker studio. U.S. payrolls marked down by most since 2009 in preliminary data. It sounds important to me. Let's go to Ira Jersey. He's the bond guy. He covers U.S. interest rate strategy for Bloomberg Intelligence. He's down in, I'm going to guess Princeton, New Jersey. Why come to the world's financial market, God forbid? Ira, thanks so much for joining us. You're the expert on this stuff. I'd love to talk to you about this U.S. payroll data and about Jackson Hole. How are you kind of writing about this in your BI research?
Yeah, the data, I think, Paul, is was more or less what a lot of people had expected. You know, kudos to our colleagues over at Bloomberg Economics who saw a number very similar to this, negative 818,000 for the revisions. Keep in mind, this is old. This is going to be revised again, and also it's not information that's new, right? So if we think about all that this means is that, yes, the data was weaker and the economy was weaker between April of 2023 and March of 2024. That doesn't necessarily tell us where we are now or where we're going over the next couple of quarters. And but it does show that maybe things weren't quite as rosy as the preliminary data suggested.
And Ira, I'm glad you brought that up because Paul and I were talking about a story I wrote ahead of that data, and it was just to that point where options traders weren't pricing in a big swing because they really saw this as backward looking, as basically a non-event for the stock market. We were seeing the S&P 500 still higher this morning. But when it comes to the bond side of things that you focus on, what is speculative positioning telling us in the bond market ahead of Powell speaking at Jackson Hole on Friday?
Yeah, I don't think the positioning really hasn't changed a whole ton over the last couple of months. And, speculators are still relatively, less short than they used to be, but they're still generally short rates. But that's because, real money investors are long, right? So for every long, there's a short in futures positioning. So you have to keep that in mind. And a lot of those shorts are going to be against other things, right? So people who are long credit or people who are trying to delta hedge options positions, for example. So all of those things go into some of that futures positioning. So you can't take as much away from that one data set as you can from, say, just the incoming data that we get. In terms of Jackson Hole, I think that the one thing that this data that we received just a couple of minutes ago does suggest is that that the Fed has more ammunition to cut interest rates. People who are worried about them cutting 25 or 50, the market kind of is now back in terms of the first cut being maybe 25 basis points. But this does give them some ammunition because they can say, oh, well, the economy is not as strong as we had thought. And because of that, that gives us at least a little bit of comfort in the fact that we can slowly start to reduce the amount of monetary tightening that we've done.
All right. Jackson Hole, Wyoming. Is it better for Fed Chairman Jay Powell to just keep it short and sweet and just let things keep moving?
Well, that's a good question. We get the minutes today at 2:00, so I think that he's going to stick to almost whatever is said in the minutes. So I think it's going to be very important to kind of read what a majority or most of the members of the Federal Reserve had said at the last meeting. But I suspect that he is going to hint that the Federal Reserve is on a path to cutting interest rates, but he's going to remain. And I think if you recall from his post-meeting press conference, he still said, like, look, we haven't made any decisions. We're doing everything. We're doing everything meeting to meeting. But when you look at a preponderance of the data, I know the retail sales data last week was pretty decent, but a lot of the other data that we're getting is mixed to somewhat lower. And certainly today's employment data suggests that things aren't as rosy as we had thought. And because of that, I think that he's going to hint that a cut is on the table.
Looking at the 10-year Treasury yield trading just below 380, what's the key levels when you're looking at the 10-year or the 2-year right now?
Yeah, so 378, so not too far from where we are right now, is a reasonably important technical level on the 10-year yield, and below that you're talking about somewhere in the 360s kind of area. 364, I think, is the next big level. Interestingly, we've kind of over the last couple of weeks, and since I left on holiday, we've been in a more or less a range, and because of that range, you've seen momentum indicators suggest that maybe we're going to stay in that range until we get something big that's going to knock us out of it.
All right, Ira, thanks so much for joining us. Ira Jersey, he's a chief U.S. interest rate strategist for Bloomberg Intelligence. Let's get back to those earnings coming out of the retailers, Macy's, TJX, Target, a whole bunch of stuff coming out there. Mary Ross Gilbert, she joins us. She's a senior analyst for Bloomberg Intelligence covering retail. She's based in Los Angeles. So, Mary, let's start with Macy's here. It just seems like, maybe one or two steps forward, one step back. What did you take away from Macy's earnings here?
Yeah, so as with any turnaround, and here we are in another iteration of trying to get growth back for this, it's the largest department store, Macy's. They did show traction in the first 50 stores. The comps were up 1%, and that was an improvement from the first quarter, which was up just less than 1%. But the fact is that the rest of the go-forward stores were down 3.7%. This is on a comparable basis, and it's owned plus licensed. So it includes licensed brands that they'll have, within the mix there. So they're showing traction in those little stores, but with the rest of the base, being very weak. And as they pointed out, they weren't really getting the conversion. What they're finding is you bring in salespeople. Wow, that's really if you think about department stores and where they came from, that's what they were known for in the past, was service. But over the last couple of decades, the service and the salespeople have sort of left the stores. Now they're finding if they bring them back, and they bring back the relevant brands, because one of the things that Tony Spring, CEO of the company, indicated is having newness and having the relevant brands that consumers care about. That's where you can get the impulse purchases. And so they're finding bringing in like a Karl Lagerfeld or a Vekla Fee, which is it's like a Parisian, a chic Parisian type brand. It's a U.S. brand, but it has that Paris streetwear aesthetic. And that's resonating really well, and they're getting very strong conversion. So bringing back service levels, bringing back the relevant brands is really making a difference in those 50 stores. So they're going to add another 100 stores where they're going to bring in service and handbags. They did see some strong sales with handbags again in those stores with the Ralph Lauren brand. So that's where I think you're going to see some improvements, is just really better signage, cleaner stores. We've been seeing those improvements in the store that we frequent. They just need to take it across the rest of the base.
And this seems like an about face, because just in May, when we had heard from Macy's previously in their prior earnings report, they had beat estimates, also raised the company's outlook for the remainder of the year. But as you know, this latest report comes on the heels of the company turning down that close to $7 billion buyout offer from one of its shareholders, Arkhouse, and of course its partner, Bridgegate Capital Management. Do we have any indication of whether or not that could be back on the table at some point?
I don't know if that'll be back on the table. I really think that they weren't able to demonstrate financing. I think that was the problem with that. And I also think that the price was low, because even though Macy's is showing very weak results right now, and the market is showing investors don't really like what they're seeing in the quarter, it's one quarter. And it's going to take time before we see real traction. So a year from now, the story could look very different if they're really able to execute on this plan, closing the stores. They haven't closed the stores yet. They're going to close the first 55. It was going to be 50. They upped it another 5 stores. Are going to close at the end of the year. They always wait until after the holidays, because that's when they generate the most cash. And then, of course, they're going to close another 100 stores over the next couple of years, but again, they might accelerate that. So it's going to take time to show traction. So we'll see how the third quarter and fourth quarter go, especially with some of the changes that they're making to these incremental stores. But nonetheless, you can see who's gaining, and it's on the off-price side.
Right.
That's where, of course, we have TJX numbers out today, and of course they beat.
Yeah, let's go to TJX, owner of TJ Maxx. Stocks hit an all-time high today.
Right.
What's TJX? What are they getting right?
What they're getting right is they have all those brands. They have the treasure hunt. There's fresh merchandise in those stores every week, and the brands range from the very high end. So they'll have Gucci and Chloe handbags. And then they'll also have like Anne Klein. So they're sort of covering all of the demographics with their assortments, and they're making it relevant by store. They have the winning formula. This is an expertise that they have built up for years, and they're the largest out there. It's a $56 billion in sales company. And so in their quarter, of course, they beat with a 4% comp sales, and the consensus was 2.7 and guidance sort of in that 1 to 2% or low single digit range. And of course, they raised their guidance. They're now expecting comp sales to be sort of in that 3 to 4% range, and they raised their EPS by about 6 cents.
Yeah, really solid results, all-time high for the stock. As you mentioned, Mary, they really got it right. Mary Ross Gilbert, thank you so much for joining us. Mary Ross Gilbert is a senior equity analyst. She covers retail for Bloomberg Intelligence. She is located in Los Angeles, California, joining us via that Zoom thing. So good news for TJX.
That's right.
Not so much for Macy's.
No, still on pace. If it holds these losses, worst day in about a year.
Okay, very good. We'll keep on top of that. S&P 500 up 15 points. That's 0.3% here this morning. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Check markets all day long at Bloomberg. We got the Dow back in the green right now. Little change, higher by 10 points. The S&P 500 index up 14, higher by about 0.3%. Stocks higher as traders look past a big downward revision of U.S. payrolls. NASDAQ up 0.3%, while the Russell 2000 index of small cap shares up 0.6. 10-year yield 3.79%. The 2-year right now 3.94%. Gold down 0.3%, 25.07 the ounce, and West Texas Intermediate crude just above $73 a barrel, down 0.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Jess Menton, she's sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. Boy, the auto industry is pulling back big time from the EV business. I mean, the latest news today, Ford Motor Company scraps electric SUV